Hey guys. Check, check. Can you hear me okay? Check, 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 check. Yeah, keyboard died, and as I was typing on the dead keyboard, it started like just shutting down my computer with all kinds of like shortcuts I didn't appreciate. I'm not presently affiliated with any gangs. Yeah, watch Powell. Yes, yes, my sickness just delayed Kathy, but yes. Trilogy. Trilogy shit. Yeah, I'm really focused on quantum right now, but I can see if I can squeeze in some other stocks. see if I can find the Fed's YouTube channel. Am I in the right place? Yeah, I bought some Arvinus. Small position. And KROS. I still have a little brain fog. I should get some coffee. No NVIDIA position for me. No meta expectations for me. We'll be streaming the conference call live for you guys. Meta and Microsoft. Gate fidelity. Talking single qubit, double qubit. Talking swap gates. Talking about Toffoli gates, Hadamard gates. Control not. D's. No position, Microsoft. Bill Gates. We found a factor for 11. What? 11 is factorable? Quantum computing determines 11, in fact, not a prime. Doing tricks on it. Doing tricks with it. How'd they do that? 11's always been a prime. It's like WWE announcer. Oh my, factored. If I'm a WWE wrestler someday, I'm definitely gonna factor people. Hit them with the factor. Hit him with shores. Oh my God. What's he gonna do with those gates? By God, he's gonna factor them. Liver toxicity. He said this was supposed to be a depression drug. Alzheimer's. $20? I thought it was 2:30. "200-second computation." How'd it stay in superposition for so long? These things decohere. Oh, the decision's it too. Okay. I don't know what HUD 8 is, sorry. So 1492 or 1942 is dead. They ever reveal the mechanism? Little is known. Oh, someone says mGluR, which would be pretty disappointing. Was there a protocol in here? Ooh. So I guess, are they still developing the halozyme combination? Will that give them some more IP? Usually, I'm not sure it would. Commercially relevant? You think so? Yeah? What are you going to do about the gate fidelity? That reminds me. Is not a static limitation? What does that mean? Gate fidelity is a limitation. I can't run a big program if the gate fidelity isn't high. Actively improving, says you. In 5 years, they got it up 50 basis points. You need 9 nines to even discuss it. Well, if the Fluxonium company was public, maybe that would be trading high, but unfortunately, we're stuck with Rigetti and IonQ, which are 99.5 at best. And that's a 1 qubit gate. Wait till you see the 2 qubit gates and the swap gates and all this other shit. It's fucking garbage. I mean, just for my tiny problems, I can't even get them to run, let alone run fast. I can't run a generic Shor's algorithm. These machines don't even work. Rigetti's still not up on AWS. I gave up on that one. Badgering IonQ enough, eventually got that one up. Let me check it out again, make sure. Rigetti's still offline. I mean, the biggest machine IonQ has is 36 qubits, which is, I mean, that's just pathetic. The amount of scaling required is just abysmal. Yeah, it's a long way to go. There's 10 or 15 orders of magnitude left. Jensen was nice when he said 6 orders of magnitude, but I think it's more like 10 or 15 orders of magnitude. And you're going to have a lot of qubits for one logical qubit. I mean, tons of error correction redundancy. And I do think at some point you'll be able to do something like Shor's. But the question is, what good is Shor's for? There's no commercial need to factor numbers. You know, so if there was an algorithm that was really exciting, that'd be great, but the most exciting algorithm is number factoring. We know what kind of error rates quantum has to achieve, because you can just use the exponent. It has to be high. Unless you want to do a 500 gate program or something stupid like that. It's just simple math. Yeah, the quantum chaos paper was a joke. I should pull it up again. You can't really combine 500 gate problems. It doesn't work that way. That's like saying if you had a 100 million instruction x86 problem, just do the instructions one at a time. I do not smoke weed. No Vyvanse either. Well, Farcoin's definitely rallying, but I will get paid. I'll take your money, don't worry. Yeah, I don't think so. I think most people think Tonics is a shit show. Is this the Federal Reserve? Does it come out here? There's minutes. Why the hell is Farcoin going up? Shut up. Shut up. Farcoin's a 0. Shut up. Ooh. You can't squeeze me. You think you're a real investor? It's Farcoin? Get out of here. I wouldn't even let you get me coffee, you'd screw it up so bad. I'm going to call Griffin on this one. Griffin's going to say, I can't manipulate that. That's crypto. That's not. So what do you mean you can't manipulate it? I know, just the idea of someone calling themselves a Farcoin investor. I mean, honestly, no matter how bad your portfolio is, it can't be worse than owning Farcoin. So if you own, you're a bag holder in quantum computing, future bag holder at least. If you're in Celis, even if you're in one of the wannabe quantum stocks like QUBT, even if you're an Anavex, it can't be worse than Farcoin. Oh shit, is it here? Is it time? Is it time? Come on, where is it? Yeah, statement. Indicators suggest economic activity is continuing to expand at a solid pace. Unemployment has stabilized at a low level. Labor market remains solid. Inflation remains elevated. Committee seeks to achieve maximum employment and inflation at 2%. Risks to achieving this employment are roughly in balance. Economic outlook is uncertain, and the committee is attentive. Decided to maintain the target range. Carefully assess data. Continue to reduce its holdings. Strongly committed to employment. Nothing in here. Yeah, I'm not sure what. Not sure what was in there, if anything. No, most people think tonics is trash. Very, very, very few people think tonics is anything but trash. Sorry, man. Yeah, Kiro's really real.
Jerome, it's President Trump. Listen, what the fuck is this? I told you to cut rate. I can fire you anytime. I can kill you anytime, Jerome. I can fucking kill you. Mr. Trump. It's President Trump to you. You see that red dot? You see that? My Secret Service guy's shining a red dot at you right now. It's not me with the cat laser pointer. That's a sniper scope. Mr. Trump, I am not going to cut rates.
Yeah, I'll stream JPal just for you guys. Let's go. King Gara, welcome. Q, D-Wave and Seal down quite a bit. Just need the rest of Quantum to catch up. Yeah, I would do Rogan. Yeah, Merck's pipeline is like god awful. You basically have three assets: Keytruda, Gardasil, and Sotatercept. No, there's an Elizabeth Warren meltdown. What did she melt down about? Love to hear it. Viral moment. Right? Looks like might be it.
Mr. Kennedy, I want to start with something that I think you and I agree on, and that is that Big Pharma has too much power in Washington. You said that President Trump asked you to, quote, clean up corruption and conflicts. Sounds great. You've said that you will, quote, slam shut the revolving door between government agencies and the companies they regulate. That also sounds great. So here's an easy question. Will you commit that when you leave this job, you will not accept compensation from a drug company, a medical device company, a hospital system, or a health insurer for at least 4 years, including as a lobbyist or a board member?
Can you just repeat the last part of the question? Can I commit?
You're not going to take money from drug companies in any way, shape, or form.
Who? Me?
Yes, you.
Oh, yeah, I'm happy to commit to that.
Okay, good. That's what I figured. I said it's an easy question to start with. And I think you're right on this.
I don't think any of them want to give me money, by the way.
Let's keep going. You're right because to say yes, because every American has the right to know that every decision you make as our number one health officer is to help them and not to make money for yourself in the future. So I want to talk more about money. I'm looking at your paperwork right now. In the past 2 years, you've raked in $2.5 million from a law firm called Wisner Baum. You go online, you do commercials to encourage people to sign up with Wisnerbaum to join lawsuits against vaccine makers. And for everyone who signs up, you personally get paid. And if they win their case, you get 10% of what they win. So if you bring in somebody who gets $10 million, you walk away with $1 million. Now, you just said that you want the American people to know you can't be bought. Your decisions won't depend on how much money you could make in the future. You won't go to work for a drug company after you leave HHS. But you and I both know there's another way to make money. So, Mr. Kennedy, will you also agree that you won't take any compensation from any lawsuits against drug companies while you are secretary and for 4 years afterwards?
Well, I'll certainly commit to that while I'm secretary, but I do want to clarify something because you're making me sound like a shill. I put together that case. I did the Science Day presentation to the judge on that case to get it into court.
Mr. Kennedy, it's just a really simple question.
Yeah.
You've taken in $2.5 million. I want to know if you will commit right now that not only will you not go to work for drug companies, you won't go to work suing the drug companies and taking your rate out of them.
Can't have it any which way.
While you're secretary and
Can't
for
do this,
4
can't do
years
that.
after. It's just
Can't work ever again.
I'm not taking any fees from drug companies while I'm secretary.
No. I'm asking about fees
Let
from
him talk.
suing drug companies. Will you agree not to do that?
You're asking me to not sue drug companies,
No,
and I'm
you
not
can
going to agree
sue
to that,
drug
Senator.
companies as much as you want.
I'm not going to agree to not sue drug companies or anybody.
So let's do a quick count here of how, as Secretary of HHS, if you get confirmed, you could influence every one of those lawsuits. Well, let me start the list. You could publish your anti-vaccine conspiracies, but this time on U.S. government letterhead, something a jury might be impressed by. You could appoint
I
people
don't
to
understand
the
that.
CDC vaccine panel who share your anti-vax views and let them do your dirty work. You could tell the CDC vaccine panel to remove a particular vaccine from the vaccine schedule. You could remove vaccines from special compensation programs, which would open up manufacturers to mass torts. You could make more injuries eligible for compensation even if there is no causal evidence. You could change vaccine court processes to make it easier to bring junk lawsuits. You could turn over FDA data to your friends at the law firm, and they could use it however it benefited them. You could change vaccine labeling. You could change vaccine information rules. You could change which claims are compensated in the vaccine injury compensation program. There's a lot of ways that you can influence those future lawsuits and pending lawsuits while you are Secretary of HHS. And I'm asking you to commit right now that you will not take a financial stake in every one of those lawsuits so that what you do as secretary will also benefit you financially down the line.
I'll comply with all the ethical guidelines.
That's not the question. You have said
You're asking
repeatedly,
me, Senator, you're asking me not to sue vaccine pharmaceutical
I am
companies.
not.
Yeah, you are.
Stop
That's exactly
enriching
what you're doing.
Well, look, no one should be fooled here. As
fought that
Secretary
from-
of HHS, Robert Kennedy will have the power to undercut vaccines and vaccine manufacturing across our country. And for all of his talk about follow the science and his promise that he won't interfere with those of us who want to vaccinate his kids, the bottom line is the same. Kennedy can kill off access to vaccines and make millions of dollars while he does it. Kids might die, but Robert Kennedy can keep cashing in.
Senator, I support vaccines. I support the childhood schedule. I will do that. The only thing I want is good science, and that's it.
How about then say you won't make money off what you do as Secretary of HHS?
Before we go to Senator Tillis, I think would be important for me to make it very clear that Mr. Kennedy has gone through the same Office of Government Ethics process as every single other nominee in the Finance Committee this year and in previous administrations. In addition to listing his assets, including the items that you've identified, he has signed an ethics letter that has been reviewed by the Office of Government Ethics concerning any possible conflict in light of its functions and the nominee's proposed duties. And we have a letter from the Office of Government Ethics that he hasn't complied completely with all applicable laws and regulations governing conflicts of interest.
Mr. Chairman, point of information here. Have we had a single nominee come through who's made $2.5 million off suing one of the entities that it would be regulating and plans to keep getting a take of every lawsuit in the future? Have we had that before?
I haven't reviewed the past documentation of every other nominee's financial interests, and so no. But I know that every single time we get a nominee, their financial interests are attacked. That's why we have the Office of Government Ethics. That's why they've reviewed everything that's in his record, and that's why he has even, I think, and I don't know that I want to ask him to get into it, but he has listed his assets and has gone through a discussion of the responsibilities under our ethics laws and has complied with all of those requirements.
She looks like a turtle. I don't own Mongo. Mitch McConnell's the super turtle. Mitch McConnell can stand in a Super Mario game. McConnell. Yeah, Lequia is not selling that well. This is the company that Novartis bought, called Medicines Company, to get Lequia, which the drug profile is pretty good, but I guess, it's still picking up steam. Yeah, New York City's worth every penny. Yeah, you're welcome to come to the Godell office, RM. As a loyal member of our company, you're more than welcome to come. Loyal member of our software. A loyal subscriber to our software. There we go. Yeah, you can meet Me, Fat Cat, Vlad, and the boys. I didn't look at ASML yet. I'm just going through all the big pharmas, basically. I'm not at the office because I'm sick. I almost didn't even stream today. Earlier I was going to stream, but I was going to like pass out. It was so bad. Thanks. I'll get better. The first one, yes. The second one, I think I got disconnected by accident. All right. I sent out a meme taunting meme coin earnings, meme coin trading. Take a look. Every day I short whiff and Farcoin and the other bullshit you think is a real financial instrument and pay my goons with it. They smoke weed and keep a lookout for any Luigi wannabes. Thanks.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The economy is strong, is strong overall, and has made significant progress toward our goals over the past 2 years. Labor market conditions have cooled from their formerly overheated state and remain solid. Inflation has moved much closer to our 2% longer run goal, though it remains somewhat elevated. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. For 2024 as a whole, GDP looks to have risen above 2%, bolstered by resilient consumer spending. Investment in equipment and intangibles appears to have slowed in the fourth quarter, but was strong for the year overall. Following weakness in the middle of last year, activity in the housing sector seems to have stabilized. In the labor market, conditions remain solid. Payroll job gains averaged 170,000 per month over the past 3 months. Following earlier increases, the unemployment rate has stabilized since the middle of last year, and at 4.1% in December remains low. Nominal wage growth has eased over the past year, and the jobs to workers gap has narrowed. Overall, a wide set of indicators suggest that conditions in the labor market are broadly in balance. The labor market is not a source of significant inflationary pressures. Inflation has eased significantly over the past 2 years, but remains somewhat elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.6% over the 12 months ending in December, and that, excluding the volatile food and energy categories, core PCE prices rose 2.8%.
Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. We see the risks to achieving our employment and inflation goals as being roughly in balance, and we are attentive to the risks on both sides of our mandate. Over the course of our 3 previous meetings, we lowered our policy rate by a full percentage point from its peak. That recalibration of our policy stance was appropriate in light of the progress on inflation and the rebalancing in the labor market. With our policy stance significantly less restrictive than it had been and the economy remaining strong, we do not need to be in a hurry to adjust our policy stance. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5%. We know that reducing policy restraint too fast or too much could hinder progress on inflation. At the same time, reducing policy restraint too slowly or too little could unduly weaken economic activity and employment. In considering the extent and timing of additional adjustments to the target range for the federal funds rate, the committee will assess incoming data, the evolving outlook, and the balance of risks. We're not on any preset course. As the economy evolves, we will adjust our policy stance in a manner that best promotes our maximum employment and price stability goals. If the economy remains strong and inflation does not continue to move sustainably toward 2%, we can maintain policy restraint for longer. If the labor market were to weaken unexpectedly, or inflation were to fall more quickly than anticipated, we can ease policy accordingly. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. As we previously announced, our 5-year review of our monetary policy framework is taking place this year. At this meeting, the committee began its discussions by reviewing the context and outcomes of our previous review that concluded in 2020, as well as the experiences of other central banks in conducting reviews. Our review will again include outreach and public events involving a wide range of parties, including Fed Listens events around the country and a research conference in May. Throughout this process, we will be open to new ideas and critical feedback, and we will take on board lessons of the last 5 years in determining our findings. We intend to wrap up the review by late summer. I would note that the committee's 2% longer run inflation goal will be retained and will not be a focus of the review. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer run inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Chairman Steve Leisman from CNBC. Mr. Chairman, at a event in Davos, or from to Davos anyway, the president said he'll demand that interest rates drop immediately. So I guess I have a 3-part question. Has the president done this to you? Has he made that demand? Secondly, what is your response to that? And third, what effect, if anything, if any, does a president make in monetary policy? Thank you.
3 questions. I'm seeing it really as one question, though. So I'm not going to have any response or comment whatsoever on what the president said. It's not appropriate for me to do so. The public should be confident that we will continue to do our work as we always have, focusing on using our tools to achieve our goals and really keeping our heads down and doing our work, and that's how we best serve the public.
Can you just comment on whether he's physically communicated his demand to you?
I've had no contact. Thanks.
Nick Timmeros, The Wall Street Journal. Chair Powell, you and several of your colleagues said around the time of the last meeting that your policy stance was meaningfully restrictive. Given economic and financial market developments since then, how has your confidence changed in an assessment that says interest rates are meaningfully restrictive?
I don't think that my assessment really has changed. I mean, a couple of things have happened. We've gotten more strong data, but we've also seen rates move up at the long end, which could represent a tightening in financial conditions. I think if we look back over the past year or so, we can see that policy is restrictive. If you look at the effect of high rates on interest-sensitive spending, for example, in housing, and if you look at the achievement of our goal variables, we're seeing the economy move toward 2% inflation and has moved largely to maximum employment. So we really look at the movement toward the goal variables to make that assessment. Now, policy is meaningfully less restrictive than it was before we began to cut. It's 100 basis points less restrictive. And for that reason, we're going to be focusing on seeing real progress on inflation, or alternatively some weakness in the labor market before we consider making adjustments.
If I could follow up, does the economy here warrant meaningfully restrictive interest rates? And would you judge interest rates to still be meaningfully restrictive if you were to lower them by another quarter point?
So I think our policy stance is very well calibrated, as I mentioned, to balance the achievement of our two goals. We want policy to be restrictive enough to continue to foster further progress toward a 2% inflation goal. At the same time, we don't need to see further weakening in the labor market to achieve that goal, and that's kind of what we've been getting. The labor market has really been broadly stable. The unemployment rate has been broadly stable now for 6 months. Conditions seem to be broadly in balance, and I'd say you look at the last couple of inflation readings and you see we don't overreact to two good readings or two bad readings, but nonetheless, the last couple of readings have suggested more positive readings. So I think policy is well positioned.
Colby from the New York Times. Colby Smith with the New York Times. Chair Powell, how should we interpret the removal of the line from the statement that inflation has made progress towards the 2% goal? Is that no longer the case?
No. So let me look. If you just look at the first paragraph, we did a little bit of language cleanup there. We took out a reference to since earlier in the year as it related to the labor market, and we just chose to shorten that sentence. Again, I mean, if you look at the sort of intermeeting data, it was good, and there was another inflation reading, I guess, just before the December meeting. So we've got two good readings in a row that are consistent with 2% inflation. Again, we're not going to overinterpret two good or two bad readings, but this was not meant to send a signal. Other than this, you can take away from all of this that we remain committed to achieving our 2% inflation goal sustainably.
And just to follow up, we've seen inflation expectations across a number of measures rise sharply, which has in part been linked to tariff concerns. But there's also been this encouraging data that you mentioned in terms of CPI and rent indices. So how would you characterize concerns about upside risks to inflation across the committee, especially those tied to policies related to the Trump administration?
Well, I'd say you see expectations moving up a little bit at the short end, but not at the longer end, where it really matters. And those could be related to what you mentioned, some of the new policies. I think where the committee is very much in the mode of waiting to see what policies are enacted. We don't know what will happen with tariffs, with immigration, with fiscal policy, and with regulatory policy. We're only just beginning to see, and actually are not really beginning to see much. And I think we need to let those policies be articulated before we can even begin to make a plausible assessment of what their implications for the economy will be. So we're going to be watching carefully, and as we always do, this is no different than any other set of policy changes at the beginning of an administration. We'll patiently watch and understand, and kind of not be in a hurry to get to a place of understanding what our policy response should be until we see how it plays out.
Michael McKee from Bloomberg Television and Radio. You and your colleagues normally condition future policy moves with the phrase, if the economy develops as we anticipate. Is it fair to say that since there's a lot unknown about what this administration's fiscal policies are actually going to be, that you don't have a medium to long-term economic forecast that you can have confidence in? Or if that's not true, can you lay out what you think is going to happen in the economy, how you see it developing.
Well, at all times, forecasts are conditional at a minimum on just a set of expectations, and they're highly uncertain in both directions. We know that economic forecasting is really difficult beyond just a month or two out. So in the current situation, there's probably some elevated uncertainty because of significant policy shifts in those 4 areas that I mentioned: tariffs, immigration, fiscal policy, and regulatory policy. So there's probably some additional uncertainty, but that should be passing. We should go through that, and then we'll be back to the regular amount of uncertainty. So, what forecasters are doing, not just us, but everybody's doing, is they've got sort of just a set of assumptions about what might happen, but they're really kind of in the nature of a placeholder, and meaning, plausible could be, but honestly, you wouldn't stand behind it because you just don't know, and so you're just on hold, waiting to see what comes down. It's a very large economy, and policy's affected at the margin, but we're going to wait and see.
If I can follow up, the idea that you feel that policy is restrictive suggests that the Fed in general wants to continue to lower interest rates. So when you look at the data that you are dependent on, are you looking for data that tell you that you can cut, or data that will tell you you should hold?
We're looking. It's more the other. The way it works is we are looking at the data to guide us in what we should do, and that's what we do. And right now, we feel like we're in a very good place. Policy's well positioned. The economy's in quite a good place, actually, as well. And what we do expect is to see further progress on inflation. And as I mentioned, as we see that, or if we were to see weakening in the labor market, that could foster. We could then be in a position of making further adjustments. But right now, we don't see that, and we see things as in a really good place for policy and for the economy. And so we feel like we don't need to be in a hurry to make any adjustments.
Howard Schneider with Reuters. Thank you very much. In 2021 at a central bank conference, you said, quote, throughout my career in both public and private sectors, I've seen that the best and most successful organizations are often the ones that have a strong and persistent commitment to diversity and inclusion. These organizations consistently attract the best talent by investing in and retaining a world-class workforce. First question is, do you still believe that? And if so, how do you intend to put that belief into practice while remaining consistent with the recent executive order prohibiting diversity and inclusion efforts?
So let me say yes, in answer to your first question. But to the second question, I want to say this. We are, like others, we're reviewing the orders and the associated details as they're made available. And as has been our practice over many administrations, we are working to align our policies with the executive orders as appropriate and consistent with applicable law. And I want to add that I'm not going to have anything more specific for you today on this whole set of issues.
Well, if I could just follow up quickly on that, I'm wondering how you're getting that to be consistent with the Dodd-Frank law's stipulations about maintaining an Office of Minority and Women's Inclusion.
So I did mention consistent with applicable law, right?
Which is government.
Elizabeth. Thanks so much. Elizabeth Schulze with ABC News. Just to follow up on Steve's question, what reassurance can you give the American public that the Fed will continue to operate independent of politics under this administration?
As I've said countless times over the years, this is who we are. This is what we do. We study the data. We analyze how it will affect the outlook and the balance of risks, and we use our tools to try to, given our best understanding, our best thinking, try to achieve our goals. That's what we do. That's always what we do. Don't look for us to do anything else. And that's, lots of research shows that that's the best way for a central bank to operate. That'll give us the best possible chance to achieve these goals for the benefit of the American people. That's always what we're going to do, and people should have confidence in that, as I said a few minutes ago.
You said that the Fed is in wait-and-see mode based on the policies that come out of this administration. Has the Fed started to model what policies like mass deportations, changes in immigration policy specifically, would look like for the workforce and for inflation?
So one of the things our staff does is they look at a range of possible outcomes, and they tend to go from really good to really bad, and it's one of the best things that they do. And in each teal book, you can look at the 5-year-old teal books and see their alternative simulations. So that's what they do. There'll be a baseline, and then they'll show 6 or 7 alternative scenarios, including really good ones and not so good ones. And what those do is they spark, the policymakers to sort of think and understand about the uncertainties that surround us. So yes, the staff does that, and we're all well aware that that the range of possibilities is always broad, and not just now, but always. And it's hard to be open to just how broad the possibilities are for an economy. No one saw the pandemic coming, and it changed everything. So things happen, but yes, we do that. But it's different. It's one thing to do that, to make assessments about what might happen and begin to think about what you might do in that case. But you don't act until you see much more than we see now.
Katerina Saraiva, Bloomberg News. Last month you talked about a future rate cut as being pretty, significantly predicated on more progress in inflation. With the characterization of the labor market in the statement today, would you say that that's even more so the case now?
I'd say it's the same. We want to see, further progress on inflation. And, the story's there. We're just going to have to see the data. At the end of the day, it comes down to 12-month inflation, because that takes out the seasonality issues that may exist. And, we're just going to need to see that. We think we see the pathway for that to happen. One example, a key example, is that you now do see owner's equivalent rent and housing services, the way it's calculated for PCE. You see that coming down pretty steadily now. And that's the place where most of the remaining gap is. In addition, a big part of the overrun, as you will know, was from non-market services, which don't tend to send much signal. So you can look through all that and think, okay, then we seem to be set up for further progress. But being seen to set up for it is one thing, having it is another. So we're going to want to see further progress on inflation. Remember, we're not, we're under 2%, but our goal is 2%, and we do mean to get back sustainably to 2%.
And in terms of the labor market, how is that broadly, you said a broad set of indicators show that it's in pretty solid place. Was there broad agreement on that? There's been a few underlying indicators that are showing perhaps some weakness, a low hiring rate, workers reporting that it's increasingly difficult to find a job. Is that of concern to the committee?
So you're right. We look at, of course, a very broad range. So it starts with unemployment, with the unemployment rate, employment participation, wages, job quits, are people quitting, that kind of thing, the ratio of vacancies to unemployed. We look at all those things, and you put your finger though on it's a low hiring environment. So if you have a job, it's all good. But if you have to find a job, the job finding rate, the hiring rates have come down, and that's more typical of let's say that the unemployment, that the labor market is at a sustainable level. It's not overheated anymore. We don't think we need it to cool off anymore. We do watch it extremely carefully. It's one of our 2 goal variables. But I'd say we watch those things quite carefully. But nonetheless, overall, look at the aggregate data in the labor market. The labor market does seem to be pretty stable and broadly in balance when you've got an unemployment rate that has been pretty stable now for a full half a year.
Thank you, Mr. Chairman. Edward Lawrence with Fox Business. On employment, now you said there's a broad range of possibilities, but last September you said, quote, "We understand that there's been quite an influx across the borders, and that has actually been one of the things that's allowed unemployment rate to rise." Now that the flow of the border has slowed and we're seeing deportations, how do you expect the unemployment rate to react?
What's happening is that the flows across the border have decreased very significantly, and there's every reason to expect that to continue. But job creation has come down a bit too. So if those two things come down together, that sort of can be a reason for the unemployment rate to stabilize. In other words, the break-even rate, as population growth slows, the break-even rate that you need in new jobs to make jobs for workers declines as well. So that seems to be something about what's happening. You do see a very flat unemployment rate at a time when you've seen significant declines.
I want to ask you about Fed employment. I know that tax money is not used here, but Elon Musk alleges that the Fed is, quote, absurdly overstaffed. We've seen the executive branch push to reduce the federal workforce. I just want to get your reaction.
We run a very careful budget process. We're fully aware that we owe that to the public, and we believe we do that. I've got no further comment than that. Thanks.
Chris Rugaber at Associated Press. President Trump has said he will lower inflation by reducing gas and energy costs. Do you see such costs as a particular driver of inflation, and would lowering them have a dramatic effect?
Chris, I'm not going to react or discuss anything that any elected politician might say. So I'll give you a mulligan.
Okay, thank you. Well, nearly 2 weeks ago, the Fed said it was withdrawing from the network for greening the financial system, even as we have significant wildfires in Los Angeles doing billions of dollars in damage. And of course, the NGFS, as you know, is a group to talk about how the financial system could address climate change. Many commentators did see the timing as political. Why did you leave that organization? Can you explain that decision?
Sure, I'd be glad to. So we considered this, really at length, and we did decide to withdraw from the NGFS. And really, the reason is that the work that the NGFS does has broadened very significantly. Think about nature-related risks and biodiversity and things like that. In addition, the work of the NGFS is in significant part intended to, and this is a quote, mobilize mainstream finance to support the transition toward a sustainable economy. So we joined to get the benefit of understanding what other central banks were doing and seeing research and things like that. I think this is just way beyond any plausible mandate that you could attribute to the Fed. And so we have a quite narrow role, as I've said many times. And I think that the activities of the NGFS are not a good fit for the Fed, given our current mandate and authority. So, and I just think it was time to acknowledge that. This process dates back, thinking about it dates back a couple of years. I made the decision to bring this to the board, some months ago. The process just took time to get here, and this is when we got it and voted on it. So, and I'm aware of how it can look, but it was really not driven by politics. It was driven by kind of the disconnect between the work of the NGFS and our mandate. Other central banks have different mandates and belong to the NGFS. We have no criticism of them, but it just isn't. It's not right for the Fed.
Thanks, Andrew Ackerman with the Washington Post. I'm wondering if you could talk more about what further progress would look like for consumers.
Well, 2% inflation down to 2% sustainably is what we're trying to achieve. We're somewhat above that, as you know, and we want to see serial readings that suggest that we're making further progress on inflation. That's what we want to see, and consumers will pick that up, of course, in the things that they buy at the grocery store or at the store.
The other thing I wanted to ask was just how far away you think you are from neutral.
Yeah, you can't know with any precision, of course. As I like to say, that you know the neutral rate by its works. So I think at 4.3%, we're above pretty much everyone on the committee's estimates of the longer run neutral. I think our eyes are telling us that our policy is having the effects on the economy. That's really the question we ask. You can consult models, empirical models, theoretical models. You really have to just look out the window and see how your policy rate is affecting the economy. And I think we see that it's having meaningful effects in bringing inflation under control. It has helped bring the labor market into balance as well. So that's what we think. I would say we're meaningfully above it. I have no illusion that anyone knows precisely how much that is. But not knowing that and having cut 100 basis points means that it's appropriate that we not be in a hurry to make further adjustments.
Victoria Guido with Politico. So as a general matter, when it comes to executive orders and OMB memos, do those always apply to the Fed, sometimes, never, or do you just often voluntarily comply? What is the legality there?
So it's been our practice, as I mentioned, to work to align our policies to those that are mentioned in the executive orders, and I'm just going to leave it at that. As I mentioned, I'm not going to go any deeper than that or get into any deeper into this set of issues today.
Claire Jones from the Financial Times. Two questions, if I may, on tariffs. Well, first of all, we've seen global trade wars before, notably in 2019, last time around, but then we were in a very different place on both inflation and growth. If we see tariffs of the same sort of magnitude that we got then, which I know is big if, what do you think might be different this time around? And secondly, Tiff Macklem said there was no doubt that the threat of tariffs was a big driver of the cut by the Bank of Canada today. What sort of information would the Fed need to see on tariffs before it was willing to take such a preemptive move? Thank you.
Sorry,
what sort of information would you need to see on tariffs? Would you need to see a strategy, actual implementation, actual movement of inflation expectations before you're actually willing to change the path of monetary policy on the basis of it?
Yeah, so first of all, things are a little different now. We've just come through a high inflation period, and you can argue that both ways. You can say that companies have figured out that they do like to raise prices, but we also hear a lot from companies these days that consumers have really had it with price increases, and so I don't know how that shakes out. Nonetheless, you're coming through a situation where we're not quite back to 2%, and that's just different. In addition, the trade, the kind of footprint of trade has changed a lot as trade is now spread around. It's not as concentrated in China as it was. There's a lot more manufacturing. It moved to Mexico and other places. So there were differences, and I just think the range of possibilities is very, very wide. We just don't know, and I don't want to start speculating, as tempting as it is, because we really don't know. And we didn't know, by the way, in 2018. We didn't really know. And the range of possibilities is very, very wide. We don't know what's going to be tariffed. We don't know for how long or how much, what countries. We don't know about retaliation. We don't know how it's going to transmit through the economy to consumers. That really does remain to be seen. There are lots of places where that price increase from the tariff can show up between the manufacturer and the consumer. Just so many variables. So we're just going to have to wait and see. And the best we can do is what we've done, which is study up on this and look at historical experience, read the literature, and think about the factors that might matter. And then we'll just have to see how it goes.
Thank you. Courtney Brown from Axios. Two unrelated questions. The first is whether or not there was any discussion about QT and the timeline for ending QT at this meeting. And then the second question is just, I wonder if the AI-prompted sell-off in the stock market this week signaled anything to you about the state of financial conditions?
So let's talk about runoff. So the most recent data do suggest that reserves are still abundant. Reserves remain roughly as high as they were when runoff began, and the federal funds rate has been very steady within the target range. We track a bunch of metrics, and they do tend to point to reserves being abundant. We do intend to reduce the size of our balance sheet to a level that's consistent with implementing monetary policy efficiently and effectively in our ample reserves regime. We're closely monitoring a range of indicators to assess conditions, and that should provide signals whether reserves are approaching a level that could be judged as, quote, somewhat above ample. I don't have anything to say to you about particular dates. It's just that's the process, and what we see is that the rates do appear to be abundant. As always, we stand ready to take appropriate action to support the smooth transition of monetary policy, including to adjust the details of our approach for reducing the size of the balance sheet in light of economic and financial developments. On AI, it's a big event in the stock market and in particular parts of the stock market. I mean, what really matters for us is macro developments, and that means substantial changes in financial conditions that are persistent for a period of time. So I wouldn't put that label on these events, although of course we're all watching it with interest.
Simon Rabinovich with The Economist. Thank you. You mentioned in your remarks that activity in the housing sector seems to have stabilized. At the same time, since your first rate cut in September, long-term mortgage rates have gone up by a full percentage point, back above 7%. I'm wondering, kind of looking forward, are you confident that activity will remain stable given how elevated mortgage rates are? How does it fit into your broader thinking about the economy?
So, as you know, as we've reduced our policy rate 100 basis points, longer rates have gone up, not because of expectations, not principally because of expectations about our policy or about inflation. It's more a term premium story. So, and it's long rates that matter for housing. So I don't think, I think these higher rates are they're probably hold back housing activity to some extent if they're persistent. We'll have to see how long they persist. So, we control an overnight rate. Generally, it propagates through the whole family of asset prices, including interest rates. But in this particular case, it's all happened at a time when, for reasons unrelated to our policy, longer rates have moved up.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You said you want to see further progress on inflation. Given that households appear to be unhappy with the elevated level of prices, do you believe the committee should wait until inflation has fallen back to target to cut rates again?
No, I wouldn't say that. We've never said we need to be all the way at target to reduce rates. At any time, what we're doing is we're looking at the economy and asking whether our policy stance is the right one to achieve maximum employment and price stability. So I think if we would want to see further progress, but we think our, as I mentioned, we think that our policy stance is restrictive, meaningfully restrictive, not highly restrictive, but meaningfully restrictive. And so I would think we need to see further progress. I wouldn't say all the way back down to 2% on a sustainable basis, although we'd love to see that, of course, and we will.
And separate question for you on tariffs. Curious whether the threat of tariffs and not knowing whether they could stick or not creates uncertainty for business here in the United States and could cause them to pull back, ultimately weighing on growth. Does the threat of tariffs cause you to ponder your growth forecast?
I want to avoid commenting even indirectly on the conduct of tariffs. It's not our job, and it's not our job to comment on the moves that people make. So I wouldn't want to criticize anything that's happening or really comment on it one way or another, praise it for that matter. It's just not our job. I do think that, we found in 2018, there was a lot of work done on trade policy uncertainty. Trade policy uncertainty, if it's large and persistent, can start to matter for businesses making investment decisions and things like that. That's not something I'm observing today. It's very early days for this, but I think that did matter in 2018-19, and it's one of many things we'll be watching.
Thank you, Chair Powell. Matt Egan from CNN. Following up on Courtney's question from earlier about the stock market, how concerned are you, if at all, about potential asset bubble brewing in financial markets? How do relatively high market valuations factor into considerations about potentially lowering interest rates further? Is that something that's in the back of your mind?
So we look at, from a financial stability perspective, at asset prices generally, along with things like leverage in the household sector, leverage in the banking system, funding risk for banks and things like that. But it's just one of the four things asset prices are. And Yeah, I'd say they're elevated by many metrics right now. A good part of that, of course, is this thing around tech and AI. We look at that. But you know, we look at how resilient the households and businesses and the financial sector are to those things. So we look at that mainly from a financial stability perspective, and we think that there's a lot of resilience out there. Banks have high capital, and households are actually overall, not all households, but in the aggregate, households are in pretty good shape financially these days. So that's how we think about that. We look at overall financial conditions, and you can't just take equity prices. You've got to look at rates too, and that represents a tightening in conditions with higher rates. So overall, financial conditions are probably still somewhat accommodative, but it's a mixed bag.
Hi, Chair Powell. I'm Richard Escobedo with CBS News. One question for you. This month's statement notes that unemployment is stabilized at a low rate and that the labor market is solid. You walked through some of what's driving this, but I wonder what risks you see that might challenge your assessment.
Well, the things we discussed earlier, one is that there's a low hiring rate. And so that if there were to be a spike in layoffs, if companies were to start to reduce headcount, you would see unemployment go up pretty quickly because the hiring rate is quite low. So that's one thing we look at. I think it's worth pointing out that for lower income households, they're under significant pressure. And in the aggregate, the numbers are good, but we know that people at the lower end of the income spectrum are struggling with costs. And really, it's high inflation for the basics of life. It's not so much the inflation now, it's the price level. Because inflation has raised prices. Inflation is now much closer to target, but people are really feeling that. But overall, this is a good labor market. You're at 4.1% unemployment. That's just a really good level, and you've been solidly there now for 6-7 months. And job creation is pretty close to a level that will hold the unemployment rate there, given that there'll be much lower population growth.
One more question. Some of the uncertainty around immigration policy, in your assessment, is that making it harder for businesses and the Fed to plan going forward?
We hear anecdotal reports, but I don't see it. There's nothing in the data yet on that. But you hear that kind of thing about construction, for example, and businesses that are
What's up, Fonta?
Dependent on immigrant labor are saying that it's suddenly gotten harder to get people. But you don't see that in the aggregate data yet. But yes, you hear it anecdotally.
Thank you, Chair Powell. Nicholas Jasinski from Barron's.
What's up, Ken?
Uncertainty is certainly a theme today. And I'm wondering, are there any periods from your career or as it relates to markets, the economy, what's going on here in Washington and beyond, or from lessons from history that may provide some guidance for a central banker operating in uncertain times like today?
I guess I'd say this. Uncertainty is with us all the time. It is human nature, apparently, to underestimate how fat the tails are in a way. The possibility, we think of things in a normal distribution, and in the economy, it's not a normal distribution. The tails are very fat, meaning things can happen way out of your expectations. It's never not that way. I wouldn't, if you think about it, think about the first few months of the pandemic. That was uncertainty. Are we going to be able to reopen the economy? If so, when? How much of it? How long will it take? That was uncertainty. What we have now is a good labor market. We have the economy growing at 2 to 2.5%. Inflation's come down to now the headline inflation number was 2.6, and that's what the public experiences. We look at core because it's a better indicator of future inflation. So yes, the price level went up a lot for inflation, and people are feeling that, and they're not wrong. But so the kind of uncertainty we have is just a usual level of uncertainty about the economy, but then policies which are not for us to criticize or praise. Those are policies which people have been elected to implement. They're implementing them with a view to making a better economy. And so I wouldn't call this out as one of those times. I wouldn't compare it to the global financial crisis or anything like that. given that we have actually a very good economy right now.
Evan Reiser with Market News International. Chair Powell, is a March cut still on the table? And then additionally, are you looking to see better than expected data on inflation to cut? Or are you looking for inflation data that roughly aligns with current forecasts?
So as I mentioned, the economy's strong, the labor market's solid, downside risks to the labor market appear to have abated, and we think disinflation continues on a slow and sometimes bumpy path. That tells me, and the other members of the committee, the broad sense of the committee actually is that we don't need to be in a hurry to adjust our policy stance. Your second question was?
Whether or not you need to see better than expected inflation data or just inflation data that roughly aligns with your current forecasts?
You know, it's one of those things we'll know it when we see it, but more the expectation is that we will make continued progress. And, you know, that's what we want. We'll know when we see it. It's going to have to be something that isn't just idiosyncratic. You're going to want to see, you know, continued progress with housing services inflation. You're going to want to see inflation behaving in a way that builds confidence that we are really making progress. That's what it's going to be. And, I mean, is that better than our expectations? We expect to see that. It's just a question of when.
Chair Powell, Scott Horsley from NPR. In your 5-year review, you said the 2% inflation target won't be on the table. Can you talk a little bit about why? Is that because you think that's the right target, or is it because you don't want to move the goalpost mid-game, or what's behind that?
I think that goal has served us well over a long period of time. It's also the sort of global standard. I think that if a central bank wanted to look at changing that, you wouldn't do it at a time when you're not meeting it anyway. I would not look at changing it anyway, but I certainly wouldn't look at it at a time when you're not meeting it. I mean, there's just no interest at all in changing it. If I'm being at all unclear, we're not going to change the inflation goal anytime soon.
And 5 years ago, if I can paraphrase what y'all decided, it was you're going to not raise interest rates preemptively to head off inflation until you see sort of the whites of the eyes of inflation, because the solid labor market was so beneficial. Have the last few years changed your thinking about that?
So what we really said was that we wouldn't look at a strong labor market and raise rates unless we saw some evidence of inflation. So the thought was that we'd seen really low levels of of unemployment with no sign of inflation. So why would you preemptively want to put people out of work in the absence of any evidence that suggested that this was not a sustainable level? It was a way of acknowledging how much humility we have about the starred variables, especially U-star, the natural rate of unemployment. So that was an insight. We'll discuss that again. That'll be one of the many things that we discuss. But I don't think that insight is wrong. We didn't, you know, we said what we said was that, you know, at times when inflation persistently undershot 2%, we would likely allow inflation to run moderately above 2% for some time. That's what we said. That turned out not to be relevant to what actually happened. There was nothing moderate about the overshoot. It was an exogenous event. It was the pandemic, and it happened. And you know, our framework permitted us to act quite vigorously, and we did once we decided that that's what we should do. The framework had really nothing to do with the decision to. We looked at the inflation as transitory, and right up to the point where the data turned against that. And when the data turned against that in late 21, we changed our view and we raised rates a lot, and here we are at 4.1% unemployment and inflation way down. But the framework was more irrelevant than anything else. That part of it was irrelevant. The rest of the framework worked just fine as we used it, as it supported what we did to bring inflation down.
Hello, Chairman Powell. Mark Hamrick with Bankrate. As you know, in the annual report from the Financial Stability Oversight Council, among the risks outlined is cryptocurrency. Could you talk about those risks now And regarding individuals and households, perhaps distinct from the concern about the financial system, do you worry that speculation in this unregulated asset class could hurt their financial well-being, or do you think it has a place in a household's portfolio?
You know, so our role with Bitcoin really is to look at, with crypto, really is to look at the banks, and you know, we think it's, you know, banks are perfectly able to serve crypto customers as long as they understand and can manage the risks, and it's safe and soundness. A good number of our banks, right, that we regulate and supervise do that. You know, the threshold has been a little higher for banks engaging in crypto activities, and that's because they're so new, and you know, we don't want to make the mistake. If you're making a choice to conduct that activity inside a bank, which is inside the federal safety net with deposit insurance, then you want to be pretty sure that it's a safe and sound activity. So, you know, we're not against innovation, and we certainly don't want to take actions that would cause banks to, you know, to terminate customers who are perfectly legal just because of excess risk aversion, maybe related to regulation and supervision. So. You know, that's kind of it's not really our bailiwick. You want people to be knowledgeable about the financial engagements that they have, and that's why we have, you know, the securities laws that we have. It's why, you know, if you read a mutual fund prospectus or individual stock prospectus, you want households to have the chance to understand the risk that they're taking. And, you know, I do think it would be helpful if there were a greater regulatory apparatus around crypto, and I think that's something Congress was working on quite a lot. We've actually spent a lot of time, you know, with members of Congress working together with them on various things, and I think that would be a very constructive thing for Congress to do. Thank you.
That's it? Okay, so which earnings call should we be? Yeah, so which earnings call should we do? Obviously, we'll look at some numbers. Yeah, Meta sounds good. We got Meta, we got Tesla, we got Intel, we got IBM. Oh, is Microsoft tonight? No, we got to do Microsoft. Yeah, I want to listen to IBM in case they say something about quantum. Yeah, that'd be amazing.
Order cancelled.
If we need capital, we have a lot of sources. Going public's always an option. I think you need to have a certain amount of revenue to really be a public company. There's no legal limit, but I don't see any good reason to go public unless you have at least 10 million in annual revenue. Probably more than that. I would say bare minimum 10 million. If you're going very fast, I mean, 10 isn't that crazy. But yeah, I would say, for software, yeah, I think you could start with 10. If you're a really small company, I don't know why you want to be public. It's a lot of paperwork. Poor IBM. Change the way they report over and over again. Unbelievable rally in Farcoin. Still down 43% over the last week, but up 32% in one day. I'll get you, my pretty. James, what's up, man? I'm homesick. I was in bed almost all day yesterday. Starting to feel a little better.
Order filled. Order cancelled. Order filled. Order filled. Order cancelled. Order cancelled. Order cancelled.
All right, here we go. Looks like Microsoft is hurting a bit. So let's see, revenue of 69.6. $69.6 was ahead of guidance. No guidance on the call. I guess people probably expected a bigger beat because the valuation is so high that without that bigger beat, then you can't get too excited about 12% revenue growth. Tesla. Let's take a look. See, I guess I can see if I can download it this way. Yeah, it's out. Tesla's out. If you go to that URL, a little trickaroo there. % revenue growth. Where's the outlook? That's pretty bearish. Robotaxi 2026. I don't remember if that was inline or a delay. Pretty sure the Microsoft guidance is like in their presentation or something. Whose call is first? Does anybody have call times? I don't see guidance anywhere. Maybe guidance has to come on the call. We should like prepared remarks. I'll be on a while. It's earnings season. Yeah, I wonder when they put out the. They're all at 5:30. How about Meta? IBM is out. Ah, there's IBM press release finally. IBM revenue growth is 1%. Is that what we're getting excited about? Look who it is.
Order partially filled. Order filled.
Oh, my poor kitty Sneezy. My little Sneezy Puff. My little Sneezy Poo Poo. Come here, I love you. I love you. Lamb research. Semiconductor. Semicap equipment name. Meta's at 5 p.m. Lam Research had a good quarter. They're closer to NVIDIA than most. Pretty sure NVIDIA is a customer, or TSM is a customer. Kind of mixed earnings season so far. I would say tilts to the negative side. Azure, slight weakness. Tesla, not so great. On the other side, IBM. Oh, also ServiceNow. But on the other side, IBM and Lam. Probably get Facebook at 4:30. Yeah, we can look at Intel. See if does IBM do it at 4:30 or 5. Five. Oh Lord, it hurts. Tempest is still up after the Nancy Pelosi trade. It's so fucking stupid. Tesla rallying. $4.30. That is like 435, if I'm not mistaken. Microsoft is 530. Not sure why Tesla's up. Dana White joining the Meta board. Yep, that's right. That was like a week or two ago. Pretty wild, right? Thank you, Seinu. Always appreciate it. Thank you, Will. We got IBM and Meta at the same time, and Microsoft and Tesla at the same time. I'm going to go with Meta Microsoft. Dana's not fully priced in yet. Okay, Microsoft should be, Meta should be any minute now. Yeah, Dana's a connection to Trump for sure. Got to glaze and do tricks on it. All right, come on, bro. Stop glazing. You're doing tricks on it already. Doing a backflip. Only thing crazier would be Joe Rogan. Twirling on it. Pogo sticking it. Suck as friends. Meta's paying Trump $25 million. Meta. Outlook 39.5 to 41.8. That's not good, right? Yeah. CapEx outlook 60 to 65. What was last year? Wow. Jesus Christ, that's a huge CapEx. That's pretty bullish for NVIDIA. Pretty huge beat for Meta. 48.39. Oh, that's not that huge a beat, actually. Guidance was 48. Consensus was 47 for some reason, but don't know why consensus would be that low. So it was a small beat of the high end. But again, I think that was to be expected. It's the next quarter's guidance that's kind of a little bit alarming. Pretty big slowdown there. Yeah, Q1's much worse than expected. The CapEx number is really big, which you have to wonder if that's a great idea given the DeepSeek results. He's talking about 60 to 65 billion CapEx. Most of that's got to be NVIDIA boxes, right? So 60 to 65 billion. Yeah, cargo therapeutics pretty wild. Gotta admit, when Zuck goes big. Traditional media doesn't want me on financial media, and I don't want to be on there either. I've always liked suzetrigine. Yeah, Meta had a good quarter. The spending guidance is pretty outlandish. I'm just gonna grab some food from the kitchen before these calls start. Oh, kitty cat. I do have a kitchen. Hi, everyone. Anything's possible. It's the same music every time. Cost cutting's pretty impressive. Tax rate dropping too is kind of crazy. Yeah, it's batshit crazy. 60 billion in fucking capex. Great for NVIDIA. I think he wants to be king of AI. It's not going to be easy. and Elon's spending $6 billion on a startup. Okay, guys, I want to spend 10 times what Elon's spending. Okay? 10 times. Whatever Elon spends, 10 times that.
Good afternoon. My name is Krista, and I will be your conference operator today. At this time, I would like to welcome everyone to the Meta fourth quarter and full year 2024 earnings conference call. All lines have been placed on. There will be a question and answer session. If you would like to ask a question, please press star 1 on your telephone keypad. To limit yourself to one question, and this call will be recorded. Thank you very much. Kenneth Dorell, Meta's Director of Investor Relations, you may begin.
Thank you. 2024 earnings conference call. Joining me today to discuss our results are Mark Zuckerberg, CEO, and Susan Li, CFO. Today will include forward-looking statements. Actual results may differ materially from those contemplated by these forward-looking statements. Earnings press release and in our quarterly report on Form 10-Q filed with the SEC. Any forward-looking statements that we make on this call are based on assumptions as of today, and we undertake no obligation to. During this call, we will present both GAAP and certain non-GAAP financial measures. A reconciliation of GAAP to non-GAAP measures is included in the investor presentation are available on our website at investor.atmeta.com. And now I'd like to turn the call over to Mark.
Ended 2024 on a strong note with now more than 3.3 billion people using at least one of our apps each day. This is going to be a really big year. I know it always feels like every year is a big year, but more than usual, it feels like the trajectory for most of our long-term initiatives is going to be a lot clearer by the end of this year. So, because we have about 48 weeks to get on the trajectory that we want to be on. In AI, I expect that the AI assistant reaches more than 1 billion people, and I expect Meta AI to be that leading AI assistant. Meta AI is already used by more people than any other assistant, and once a service reaches that kind of scale, it usually develops a durable long-term advantage. We have a really exciting roadmap for this year with a unique vision focused on personalization. We believe that people don't all want to use the same AI. People want their AI to be personalized to their context, their interests, their personality, their culture, and how they think about the world. I don't think that there's just going to be one big AI that everyone uses that does the same thing. People are going to get to formative products that we've made, and we have some fun surprises that I think people are going to like this year. I think this will very well be the year when Llama and open source become the most advanced and widely used AI models as well. Llama 4 is making great progress in training. Llama 4 Mini is done with pre-training, and our reasoning models and larger model are looking good too. Our goal with Llama 3 was to make open source competitive with closed models, and natively multimodal. It's an omni model, and it will have agentic capabilities. So it's going to be novel, and it's going to unlock a lot of new use cases, and I'm looking forward to sharing more of our plan for the year on that over the next couple of months. I also expect that 2025 will be the year when it becomes possible to build an AI engineering agent that has coding and problem-solving abilities of around a good mid-level engineer. And this is going to be a profound milestone. In history, as well as over time, potentially a very large market. Whichever company builds this first, I think is going to have a meaningful advantage in deploying it to advance their AI research and shape the field. So that's another reason why I think that this year is going to set the course for the future. Our Ray-Ban Meta AI glasses are a real hit, and this will be the year when we understand the trajectory for AI glasses as a category. Many breakout products in the history of consumer electronics have sold 5 to 10 million units in their third generation. This will be a defining year that determines if we're on a path towards many hundreds of millions and eventually billions of AI glasses, and glasses being the next computing platform like we've been talking about for some time, or if this is just going to be a longer grind. But it's great overall to see people recognizing that these glasses are the perfect form factor for AI, as well as just great stylish glasses. These are all big investments, especially the hundreds of billions of dollars that we will invest in AI infrastructure over the long term. I announced last week that we expect to bring online almost 1 gigawatt of capacity this year, and we're building a 2 gigawatt and potentially bigger AI data center that is so big that it'll cover a significant part of Manhattan if it were placed there. We're planning to fund all of this by, at the same time, investing aggressively in initiatives that use these AI advances to increase revenue growth. And we've put together a plan that will hopefully accelerate the pace of these initiatives over the next few years. That's what a lot of our new headcount growth is going towards. And how well we execute on this will also determine our financial trajectory over the next few years. There are a number of other important product trends related to our family of apps that I think we're going to know more about this year as well. We're going to learn what's going to happen with TikTok. And regardless of that, I expect Reels on Instagram and Facebook to continue growing. I expect Threads to continue on its trajectory to become the leading discussion platform and eventually reach 1 billion people over the next several years. Threads now has more than 320 million monthly actives and has been adding more than 1 million signups per day. I expect WhatsApp to continue gaining share and making progress towards becoming the leading messaging platform in the US, like it is in a lot of the rest of the world. WhatsApp now has more than 100 million monthly actives in the US. Facebook is used by more than 3 billion monthly actives, and we're focused on growing its cultural influence. And I'm excited this year to get back to some OG Facebook. All right, so this is also going to be a pivotal year for the metaverse. The number of people using Quest and Horizon has been steadily growing. And this is a year when a number of the long-term investments that we've been working on that will make the metaverse more visually stunning and inspiring will really start to land. So I think we're going to know a lot more about Horizon's trajectory by the end of this year. This is also going to be a big year for redefining our relationship with governments. We now have a U.S. administration that is proud of our leading companies, prioritizes American technology winning, and that will defend our values and interests abroad. And I am optimistic about the progress and innovation that this can unlock. So this is going to be a big year. I think that this is the most exciting and dynamic that I have ever seen our industry. Between AI, glasses, massive infrastructure projects, doing a bunch of work to try to accelerate our business and building the future of social media, we have a lot to do. And I think we're going to build some awesome things that shape the future of human connection. As always, I am grateful for everyone who's on this journey with us. Thank you. Here's Susan.
Thanks, Mark, and good afternoon, everyone. Let's begin with our consolidated results. All comparisons are on a year-over-year basis, unless otherwise noted. Q4 total revenue was $48.4 billion, up 21% on both a reported and constant currency basis. Q4 total expenses were $25 billion, up 5% compared to last year. Before I cover the specific cost lines, I would note that our fourth quarter expense growth rate reflects a 13 percentage point favorable impact from legal accrual reductions in Q4 and lower year-over-year restructuring costs. In terms of the specific line items, cost of revenue increased 15%, driven mostly by higher infrastructure costs. R&D increased 16%, primarily driven by higher employee compensation and infrastructure costs, which were partially offset by lower restructuring costs. Marketing and sales were approximately flat year over year. G&A decreased 67%, driven mostly by lower legal-related expenses due to a $1.55 billion reduction in legal accruals related to certain legal proceedings. We ended the year with over 74,000 employees, up 10% year over year, with growth primarily driven by hiring in priority areas of monetization, infrastructure, generative AI, Reality Labs, as well as regulation and compliance. Fourth quarter operating income was $23.4 billion, representing a 48% operating margin. Our tax rate for the quarter was 12%.
Look at this insane expense reduction. Insane expense reduction.
$8 billion, or $8.02 per share. Capital expenditures, including principal payments on finance leases, were $14.8 billion, driven by investments in servers, data centers, and network infrastructure. Free cash flow was $13.2 billion. We paid $1.3 billion in dividends to shareholders, ending the year with $77.8 billion in cash and marketable securities and $28.8 billion in debt. Moving now to our segment results. I'll begin with our Family of Apps segment. Our community across the Family of Apps continues to grow, and we estimate more than 3.3 billion people used at least one of our Family of Apps on a daily basis in December. Q4 total Family of Apps revenue was $47.3 billion, up 21% year over year, and Q4 Family of Apps ad revenue was $46.8 billion, up 21% on both a reported and constant currency basis. Within ad revenue, the online commerce vertical was the largest contributor to year-over-year growth. On a user geography basis, ad revenue growth was strongest in rest of world at 27%, followed by Asia Pacific and Europe at 23% and 22% respectively. North America grew 18%. In Q4, the total number of ad impressions served across our services increased 6%, and the average price per ad increased 14%. Impression growth was mainly driven by Asia Pacific. Pricing growth benefited from increased advertiser demand, in part driven by improved ad performance. This was partially offset by impression growth, particularly from lower monetizing regions and surfaces. Family of Apps other revenue was $519 million, up 55%, driven primarily by business messaging revenue growth from our WhatsApp business platform. We continue to direct the majority of our investments toward the development and operation of our Family of Apps. In Q4, Family of Apps expenses were $19 billion, representing 76% of our overall expenses. Family of Apps expenses were up 5%, primarily due to growth in infrastructure costs and employee compensation, which were partially offset by lower legal-related expenses. Family of Apps operating income was $28.3 billion, representing a 60% operating margin. Within our Reality Labs segment, Q4 revenue was $1.1 billion, driven by hardware sales and up 1% year over year. Reality Labs expenses were $6 billion, up 6% year over year, driven primarily by higher infrastructure costs and employee compensation, partially offset by lower restructuring costs. Reality Labs operating loss was $5 billion. Turning now to the business outlook. There are two primary factors that drive our revenue performance: our ability to deliver engaging experiences for our community and our effectiveness at monetizing that engagement over time. On the first, daily actives continue to grow across Facebook, Instagram, and WhatsApp year over year, both globally and in the United States. In Q4, global video time grew at double-digit percentages year over year on Instagram, and we're seeing particular strength in the US on Facebook, where video time spent was also up double-digit rates year over year. We see continued opportunities to drive video growth in 2025 through ongoing optimizations to our ranking systems. We're also making several product bets that are focused on setting up our platforms for longer-term success. Creators are one of our central focuses. On Instagram, we continue to prioritize original posts and recommendations to help smaller creators get discovered. We also want to ensure creators have a place to experiment with their content, so we introduced a new feature in Q4 that allows creators to first share a reel with people who don't follow them. This allows them to test content and see what performs best before deciding to share it with their followers, and also helps introduce them to entirely new audiences. Creative tools is another area we're investing in. In the coming weeks, we'll launch a new standalone app called Edits that provides a full suite of creative tools to make it easier for creators to make great reels on their phone. Another focus is making it easier for people to connect over content. Reels are already reshared over 4.5 billion times a day, and we've been introducing more features that bring together the social and entertainment aspects of Instagram. In the US, we recently launched a new destination in Reels that consists of content your friends have left a note on or liked. We're seeing very positive early results, and we'll look to expand this globally in the coming months. On Threads, we made tremendous progress in 2024, and our focus this year is establishing Threads as the place people come to keep up with what they care about. We're making a number of updates to our recommendation systems to prioritize more recent posts, surface content from top creators, and ensure people see more of the content from accounts they follow. We will also continue improving custom feeds so people can build personalized feeds on topics they're interested in. Finally, Meta AI usage continues to scale with more than 700 million monthly actives. We're now introducing updates that will enable Meta AI to deliver more personalized and relevant responses by remembering certain details from people's prior queries and considering what they engage with on Facebook and Instagram to develop better intuition for their interests and preferences. Now to the second driver of our revenue performance, increasing monetization efficiency. The first part of this work is optimizing the level of ads with an organic engagement. We continue to grow supply on lower monetizing surfaces like video, while optimizing ad supply on each of our surfaces to deliver ads at the time and place they will be most relevant to people. For example, we are continuing to better personalize when ads show up, including the optimal locations in the depth of someone's feed, to introduce ad supply when it's most optimal for the user and revenue. This is enabling efficient supply growth. Longer term, we also see impression growth opportunities on unmonetized surfaces like Threads, which we are beginning to test ads on this quarter. We expect the introduction of ads on Threads will be gradual and don't anticipate it being a meaningful driver of overall impression or revenue growth in 2025. The second part of increasing monetization efficiency is improving marketing performance. The ongoing enhancements to our ads ranking systems are an important driver of this work. In the second half of 2024, we introduced an innovative new machine learning system in partnership with NVIDIA called Andromeda. This more efficient system enabled a 10,000 times increase in the complexity of models we use for ads retrieval, which is the part of the ranking process where we narrow down a pool of tens of millions of ads to the few thousand we consider showing someone. The increase in model complexity is enabling us to run far more sophisticated prediction models to better personalize which ads we show someone. This has driven an 8% increase in the quality of ads that people see on objectives we've tested. Andromeda's ability to efficiently process larger volumes of ads also positions us well for the future as advertisers use our generative AI tools to create and test more ads. Another way we're delivering value for advertisers is through increased automation of their ad campaigns with Advantage Plus. Adoption of Advantage Plus shopping campaigns continues to scale, with revenue surpassing a $20 billion annual run rate and growing 70% year over year in Q4. Given the strong performance and interest we're seeing in Advantage Plus shopping and our other end-to-end solutions, we're testing a new streamlined campaign creation flow so advertisers no longer need to choose between running a manual or Advantage Plus sales or app campaign. In this new setup, all campaigns optimizing for sales, app, or lead objectives will have Advantage Plus turned on from the beginning. This will allow more advertisers to take advantage of the performance Advantage Plus offers, while still having the ability to further customize aspects of their campaigns when they need to. We plan to expand to more advertisers in the coming months before fully rolling it out later in the year. Advantage Plus Creative is another area where we're seeing momentum. More than 4 million advertisers are now using at least one of our generative AI ad creative tools, up from 1 million 6 months ago. There has been significant early adoption of our first video generation tool that we rolled out in October, Image Animation, with hundreds of thousands of advertisers already using it monthly. Next, I would like to discuss our approach to capital allocation. Our primary focus remains investing capital back into the business, with infrastructure and talent being our top priorities. On the first, we expect compute will be central to many of the opportunities we're pursuing as we advance the capabilities of Llama, drive increased usage of generative AI products and features across our platform, and fuel core ads and organic engagement initiatives. We're working to meet the growing capacity needs for these services by both scaling our infrastructure footprint and increasing the efficiency of our workloads. Another way we're pursuing efficiencies is by extending the useful lives of our servers and associated networking equipment. Our expectation going forward is that we'll be able to use both our non-AI and AI servers for a longer period of time before replacing them, which we estimate will be approximately 5.5 years. This will deliver savings in annual CapEx and resulting depreciation expense, which is already included in our guidance. Finally, we're pursuing cost efficiencies by deploying our custom MTIA silicon in areas where we can achieve a lower cost of compute by optimizing the chip to our unique workloads. In 2024, we started deploying MTIA to our ranking and recommendation inference workloads for ads and organic content. We expect to further ramp adoption of MTIA for these use cases throughout 2025 before extending our custom silicon efforts to training workloads for ranking and recommendations next year. From a hiring standpoint, our focus continues to be on adding technical talent to support our strategic priorities. In the fourth quarter, nearly 90% of our year-over-year headcount growth was within the R&D function. The remaining growth was primarily in cost of revenue as we added infrastructure headcount to support our data center operations. In 2025, we expect headcount growth will continue to be primarily driven by technical roles across our priority initiatives within infrastructure, monetization, Reality Labs, generative AI, as well as regulation and compliance. We anticipate headcount growth in our business functions will remain relatively limited. To achieve our ambitions in these areas, we will need to continue executing at a rapid pace. We're supporting this by building tools to help our engineering base be more productive. As part of our efficiency focus over the past 2 years, we've made significant improvements in our internal processes and developer tools and introduced new tools like our AI-powered coding assistant, which is helping our engineers write code more quickly. Looking forward, we expect that the continuous advancements in Llama's coding capabilities will provide even greater leverage to our engineers, and we are focused on expanding its capabilities to not only assist our engineers in writing and reviewing our code, but to also begin generating code changes to automate tool updates and improve the quality of our code base. Finally, we expect our strong financial position will enable us to support these investments while continuing to return capital to shareholders through share repurchases and dividends. Moving to our financial outlook, we expect first quarter total revenue to be in the range of $39.5 to $41.8 billion. This reflects 8 to 15% year-over-year growth, or 11 to 18% growth on a constant currency basis, as our guidance assumes foreign currency is an approximately 3% headwind to year-over-year total revenue growth based on current exchange rates. This also reflects the effect of lapping leap day in the first quarter of 2024. While we are not providing a full year 2025 revenue outlook, we expect the investments we're making in our core business this year will give us an opportunity to continue delivering strong revenue growth throughout 2025. Turning now to the expense outlook, we expect full year 2025 total expenses to be in the range of $114 to $119 billion. We expect the single largest driver of expense growth in 2025 to be infrastructure costs driven by higher operating expenses and depreciation. We expect employee compensation to be the second largest factor as we add technical talent in the priority areas that I referenced earlier. Turning now to the CapEx outlook, we expect our full year 2025 capital expenses will be in the range of $60 to $65 billion. We expect CapEx growth in 2025 will be driven by increased investment to support both our generative AI efforts and our core business. The majority of our CapEx in 2025 will continue to be directed towards our core business. On to tax. Absent any changes to our tax landscape, we expect our full year 2025 tax rate to be in the range of 12 to 15%. In addition, we continue to monitor an active regulatory landscape, including legal and regulatory headwinds in the EU and the US that could significantly impact our business and our financial results. In closing, this was a good year for our company, with investments across our priority areas delivering strong business performance and innovative new products for our community. We have a compelling set of opportunities to invest in this year, which we expect will help us drive continued strong growth and develop transformative technologies that shape the future of our company and of the industry. With that, Krista, let's open up the call for questions.
Thank you. We will now open the lines for a question and answer session. To ask a question, please press star one on your touchtone phone. To withdraw your question, again, press star one. Please limit yourself to one question. Please pick up your handset before asking your question to ensure clarity. If you are streaming today's call, please mute your computer speakers. And our first question comes from the line of Brian Nowak with Morgan Stanley. Please go ahead.
Thanks for taking my questions. Mark, you sound we appreciate all the excitement about this year and all of the innovation to come. I know there's a lot of announcements throughout the course of the year, but wonder if you could just share a few sort of high-level examples of your vision on new potential use cases and offerings that could drive utility for your users and value for your advertisers as you sort of think about Llama 4 and Meta AI changing throughout 2025. And then the second one on custom silicon, maybe a question for either of you, just any learnings on the difference between your custom silicon and third-party chips in your ranking models and results, and how should we think about the main gating factors as to how quickly you'll be able to move a higher percentage of your engagement to your custom silicon? Thanks.
On the first one, I tried to lay this out in my opening comments a bit. I mean, we're very focused on Meta AI as a highly intelligent and personalized assistant that you can access across our apps. There's a website, you can access it outside of our apps too. I think that the quality of this is just, it's going to keep on improving and improved a lot over the last year. We're also finding more ways that it's useful to integrate it into our services to help more people discover it. I think that that's undoubtedly why so many hundreds of millions of people are using it today, is because it's kind of easy to discover what we're doing and then keep using it. I don't know. I want to keep some surprises and fun for the stuff that we're going to release this year. I gave a bit of detail on what we're planning to do with Llama 4 that I'm sure technical people will enjoy because we hadn't talked about that before. But I'm going to refrain from adding a whole lot more on what we're launching this year. But it's the different things that I talked about. It's Meta AI. I do expect Llama 4 to be a very exciting set of releases. It's not just one thing. Just like with Llama 3, there were kind of a few different models at different dates. I think we'll see that with Llama 4 too. And then the AI engineer piece, I'm really excited about. I mean, I don't know that that's going to be an external product anytime soon, but I think for what we're working on, our goal is to advance AI research and advance our own development internally. And I think it's just going to be a very profound thing. So, I mean, that's something that I think will show up through making our products better over time. But yeah, and then as that works, there will potentially be a market opportunity down the road. But I mean, for now, and this year, we're really, I think I don't think you're going to see this year like an AI engineer that is extremely widely deployed, changing all of development. I think this is going to be the year where that really starts to become possible and lays the groundwork for a much more dramatic change in 26 and beyond. I don't know. Yeah, that's kind of it.
Brian, I'm happy to take your second question about custom silicon. So first of all, we expect that we are continuing to purchase third-party silicon from leading providers in the industry. And we are certainly committed to those longstanding partnerships, but we're also very invested in developing our own custom silicon for unique workloads where off-the-shelf silicon isn't necessarily optimal. And specifically because we're able to optimize the full stack to achieve greater compute efficiency and performance per cost and power, because our workloads might require a different mix of memory versus network, bandwidth versus compute, and so we can optimize that really to the specific needs of our different types of workloads. Right now, the in-house MTIA program is focused on supporting our core ranking and recommendation inference workloads. We started adopting MTIA in the first half of 2024 for core ranking and recommendations inference. We'll continue ramping adoption for those workloads over the course of 2025 as we use it for both incremental capacity and to replace some GPU-based servers when they reach the end of their useful lives. Next year, we're hoping to expand MTIA to support some of our core AI training workloads and over time, some of our Gen AI use cases.
Your next question comes from the line of Eric Sheridan with Goldman Sachs. Please go ahead.
Thank you so much for taking the question. Maybe I can go back to your comments on open source. Can you help us understand how your views continue to evolve with respect to the competitive dynamic around your approach with open source versus others in the industry, and how your approach to open source could possibly bend the cost curve and improve return on capital for AI over the medium to long term? Thanks so much.
Yeah, I mean, on open source, I think the best analogy for us is what we did with Open Compute, where we weren't first to building the system. So then by the time that we got around to building it, it wasn't really a big advantage to have it be proprietary. So we shared it. And then a lot of the industry adopted what we were doing, contributed innovations back to it. By standardizing it on it, that meant that a bunch of supply chains standardized on building it, which made prices more efficient for everyone. I think what we see here is, as Llama becomes more used, it's more likely, for example, that silicon providers and others, other APIs and developer platforms will optimize their work more for that, and basically drive down the costs of using it and drive improvements that we can, in some cases, use too. So I think that the strategy will continue to be effective. And yeah, I mean, I continue to be optimistic about this. I think it's I think it's working. I also just think, in light of some of the recent news, the new competitor, DeepSeek from China, I think it also just puts, it's one of the things that we're talking about is there's going to be an open source standard globally. And I think for our kind of own national advantage, it's important that it's an American standard. So we take that seriously, and we want to build the AI system that people around the world are using. And I think that if anything, some of the recent news has only strengthened our conviction that this is the right thing for us to be focused on.
Your next question comes from the line of Mark Shmulik with Bernstein. Please go ahead.
Yes, thank you for taking my questions. Mark, appreciate we may get an answer this year, but looking out, as you've kind of tracked the progress of smart glasses, Orion and so forth, do you view that as a better form factor to get the most out of the Meta AI assistance you highlighted in your opening remarks? Or is it more complementary to kind of the in-app experience and the way you've seen people use it today? And then Susan, the last few quarters, we've kind of seen pricing growth as the dominant driver of ad revenue growth. Given the efforts you've highlighted around driving deeper, more commercial engagement and better advertiser ROI, how do we just think about the contribution or the formula for ad revenue growth going forward? Thank you.
Yeah, I mean, I can talk about glasses. I mean, I've said for a while that I think that glasses are the ideal form factor for an AI device because you can let an AI assistant on your glasses see what you see and hear what you hear, which gives it the context to be able to understand, everything that's going on in your life that you would want to talk to it about and get context on. So, but look, I mean, I think that glasses are going to be a very important computing platform in the future. When phones became the primary computing platform, it's not like computers went away. I think we'll have phones for some time, but there are a lot of people in the world who have glasses. It's kind of hard for me to imagine that a decade or more from now, all the glasses aren't going to basically be AI glasses, as well as a lot of people who don't wear glasses today finding that to be a useful thing. So I'm incredibly optimistic about this. And like I shared last year, I think one of the big surprises last year was I'd previously thought that glasses weren't going to become a major form factor until we got the full kind of holographic displays that we started showing in the prototype for Orion. But now I think it's pretty clear that AI is actually going to drive at least as much of the value as the holographic AR is. So that's a cause to be excited. But look, the Ray-Ban Metas were a hit. We still don't know what the long-term trajectory for this is going to be. And I think we're going to learn a lot this year. So I think that this is a really important year for that.
And I can take the second question on pricing growth. So first of all, what I would say is over the long term, we think we have continued opportunity to drive revenue growth across both pricing and impression growth. So both sort of supply and demand dimensions. When we look at pricing, our reported growth can be influenced by different factors such as supply, because of the auction dynamics, by the mix shift of the different types of surfaces where ads show up. For example, services like video are lower monetization efficiency, relatively speaking. And then, of course, broader macro factors. But we generally expect that, we are going to be able to deliver ongoing ad performance improvements through a lot of the, ongoing work that we're doing across our monetization roadmap. And that will have the sort of effect of benefiting pricing overall. And part of, what I think is kind of important to think about here when we think about price growth is the average price per ad as we report it is really blending, it's an output metric. It's blending a lot of things that are happening, including what are advertisers bidding for, what are their bids for those things, what is the average cost of their action. So given that there are so many different objectives that advertisers can optimize for that have different values, it's a very complex metric that tries to distill that into one thing. Overall, we are seeing healthy cost per action trends for advertisers for whatever is the action that they are optimizing for. And we believe we'll continue to get better at driving conversions for advertisers. And when we do, that will have the effect of continuing to lift CPMs over time because we're delivering more conversions per impression served, resulting in higher value impressions.
Your next question comes from the line of Justin Post with Bank of America. Please go ahead.
Great, thanks. Maybe one for Mark and one for Susan. Mark, you mentioned political changes in the U.S. and better positioning maybe for U.S. companies abroad, but how do you think about it in the U.S. as far as usage and advertiser adoption? You got rid of fact checking, so do you think the content could change? Could it appeal to more users? Will that impact advertising at all? And then Susan, on Meta AI, I know people are pretty excited about the use case, but also thinking about the revenue case. How do you think about monetizing that? Could it be CPC ads or how are you thinking about that? Thank you.
The question was about fact checking and our content policies. I mean, look, I think we're trying to build the service that we think is the best for people. I've believed in free expression for quite a while. People don't want to see misinformation, but you need to build an effective system that gives people more context. And I think what we found over time is that the community notes system, I think, is just going to be more effective than the system that we had before. And I'm not afraid to admit when someone does something that's better than us. I think it's sort of our job to go and just do the best work and implement the best system. So I think that there's been a lot of people who have read this announcement as if we somehow don't care about adding context to things that are on our platform that are misinformation. That's not right. I actually think that the community notes system, like what X has had for a while, is actually just more effective than what we were doing before, and I think our product is going to get better because of it.
I would add to that just to say we also haven't seen any noticeable impact from our content policy changes on advertiser spend. So we're continuing to see strong advertiser demand, again, particularly for AI-powered tools that are helping businesses maximize the value of their ad spend. So our commitment to brand safety is unchanged, and we expect that we will invest in our suite of tools to meet the needs of advertisers. On your second question, in terms of monetizing Meta AI, our initial focus for Meta AI is really about building a great consumer experience, and that's frankly where all of our energies are kind of directed to right now. There will, I think, be pretty clear monetization opportunities here over time, including paid recommendations and including a premium offering, but that's really not where we are focused in terms of the development of Meta AI today.
Your next question comes from the line of Douglas Anmuth with JP Morgan. Please go ahead.
Thanks for taking the questions. One for Mark, one for Susan. Mark, just following up on open source, as DeepSeek and other models potentially leverage Llama or others to train faster and cheaper, how does this impact Meta in your view, and what could it mean for the trajectory of investment required over a multi-year period? And then Susan, just as we think about the 60 to 65 billion in CapEx this year, does the composition change much from last year when you talked about servers as the largest part, followed by data centers and networking equipment? And how should we think about that mix between like training and inference, just following up on Jan's post this week? Thanks.
I can start on the DeepSeek question. I think that there's a number of novel things that they did that I think we're still digesting, and there are a number of things that they have advances that we will hope to implement in our systems, and that's part of the nature of how this works, whether it's a Chinese competitor or not. I kind of expect that every new company that has an advance, that has a launch, is going to have some new advances that the rest of the field learns from, and that's sort of how the technology industry goes. I don't know. It's probably too early to really have a strong opinion on what this means for the trajectory around infrastructure and CapEx and things like that. There are a bunch of trends that are happening here all at once. There's already sort of a debate around how much of the compute infrastructure that we're using is going to go towards pre-training versus as you get more of these reasoning time models or reasoning models where you get more of the intelligence by putting more of the compute into inference, whether just it will shift how we use our compute infrastructure towards that. that was already something that I think a lot of the other labs and ourselves were starting to think more about, and already seemed pretty likely even before this. That like of all the compute that we're using, that the largest pieces aren't necessarily going to go towards pre-training. But that doesn't mean that you need less compute, because one of the new properties that's emerged is the ability to apply more compute at inference time in order to generate a higher level of intelligence and a higher quality of service, which means that as a company that has a strong business model to support this, I think that's generally an advantage, that we're now going to be able to provide a higher quality of service than others who don't necessarily have the business model to support it on a sustainable basis. The other thing is just that when we're building things like Meta AI, but also how we're implementing AI into all the feeds and ad products and things like that, we're just serving billions of people, which is different from, okay, you start to pre-train a model, and that model is sort of agnostic to how many people are using it. Like, at some level, it's going to be expensive for us to serve all of these people because we are serving a lot of people. And so I'm not sure what the kind of net effect of all of this is. The field continues to move quickly. There's a lot to learn from releases from basically everyone who does something interesting, not just the ones over the last month. We'll continue to kind of incorporate that into what we do, as well as making novel contributions to the field ourselves. And I continue to think that investing very heavily in CapEx and infra is going to be a strategic advantage over time. It's possible that we'll learn otherwise at some point, but I just think it's way too early to call that. And at this point, I would bet that the ability to build out that kind of infrastructure is going to be a major advantage for both the quality of the service and being able to serve the scale that we want to.
I'm happy to add a little more color about our 2025 CapEx plans to your second question. So we certainly expect that 2025 CapEx is going to grow across all three of those components you described. Servers will be the biggest growth driver. That remains the largest portion of our overall CapEx budget. We expect both growth in AI capacity as we support our Gen AI efforts and continue to invest meaningfully in core AI. But we are also expecting growth in non-AI capacity as we invest in the core business, including to support a higher base of engagement and to refresh our existing servers. On the data center side, we're anticipating higher data center spend in 2025 to be driven by buildouts of our large training clusters and our higher power density data centers that are entering the core construction phase. We're expecting to use that capacity primarily for core AI and non-AI use cases. On the networking side, we expect networking spend to grow in 25 as we build higher capacity networks to accommodate the growth in non-AI and core AI related traffic, along with our large Gen AI training clusters. We're also investing in fiber to handle future cross-region training traffic. And then in terms of the breakdown for core versus Gen AI use cases, we're expecting total infrastructure spend within each of Gen AI, non-AI, and core AI to increase in 25, with the majority of our CapEx directed to our core business, with some caveat that that's not easy to measure perfectly, as the data centers we're building can support AI or non-AI workloads, and the GPU-based servers we procure for Gen AI can be repurposed for core AI use cases, and so on and so forth. But overall, I would reiterate what Mark said. We are committed to building leading foundation models and applications. We expect that we're going to make big investments to support our training and inference objectives, and we don't know exactly where we are in the cycle of that yet.
Your next question comes from the line of Ron Josey with Citigroup. Please go ahead.
Great, thanks for taking the question. Mark, I want to get back to your comment on getting back to the OG Facebook, and I want to understand a little bit more on the use cases and how that could expand. Video is clearly a benefit. Local marketplace groups have all been positive. So any insights on the OG Facebook? And then back to Meta AI, given the adoption we're seeing on the 600 plus MAUs, just how has the user experience evolved here? What are people doing with Meta AI? Thank you.
Okay, so for Facebook, a lot of people use Facebook every day, and it's an important part of their lives. And I think that there are a lot of opportunities to make it way more culturally influential than it is today. And I think that that's sort of a fun and interesting goal that will take our product development in some interesting directions that we um, maybe haven't focused on as much over the last several years. So I don't know that I have anything much more specific on this other than that this is going to be a one of my focus areas for this year. I think it's it's an investment area and something I'm going to spend some time on. It might mean that in the near term uh, we make some trade-offs to kind of focus on some product areas of what we're doing um, ahead of just kind of maximizing business results in the near term on it. But overall, I'm really excited about doing some exciting stuff here, and not going to get into many specifics now, but we'll follow up on this over the next I don't know, call it half a year, a year, as we start rolling stuff out. And I think some of this will kind of get back to how Facebook was originally used back in the day. So I think it'll be fun.
I'm happy to share a little bit more about Meta AI and what people are doing with it. We are in a phase where we are really learning a lot from the way that people engage with Meta AI. So, from an app perspective, WhatsApp continues to see the strongest Meta AI usage across our family of apps. People there are using it most frequently for information seeking and educational queries, along with emotional support use cases. Most of the WhatsApp engagement is in one-on-one threads, though we see some usage in group messaging. And on Facebook, which is the second largest driver of Meta AI engagement, we're seeing strong engagement from our feed deep dives integration that lets people ask Meta AI questions about the content that is recommended to them. So across, I would say, all query types, we continue to see signs that Meta AI is helping people leverage our apps for new use cases. We talked about information gathering, social interaction, and communication. Lots of people use it for humor and casual conversation. They use it for writing and editing, research, recommendations. And as we look forward to 2025 in our Meta AI roadmap, we are really focused on doing more to make it feel more personalized. So that I would say some of the most exciting features we're working on, including improving sort of the memory dimension of the Meta AI experience, where it will be able to remember certain details that people share in one-on-one chats, for example, and use those details to personalize its responses. And then, really increasing its ability to deliver great content recommendations and enhance really what makes Facebook and Instagram so valuable for people today.
Your next question comes from the line of Ken Grorowski with Wells Fargo. Please go ahead.
Thank you very much. Two for me, please. First, could you talk a little bit? I know you talked a little bit on the capital intensity side and the recent developments, and it's hard to see, it's hard to tell yet where things are going. But maybe you could just talk a little bit more near term about 25, the capex budget you laid out, or the capex forecast. Could you talk a little bit about the constraints you're seeing, or where you're seeing constraints, either internally, resources planning, or externally, in any parts of the ecosystem? And then on the second one, I'm curious, as you think about your needs for hiring. And we just think about, we knew you gave the OpEx guide for this year, but as we think about future needs for hiring, could you just give us a sense of how we should think about that? You announced the performance-related reductions earlier this year. Could you just talk about how we should be thinking about that 26, 27, and beyond? Thank you.
Sure, I'm happy to take both of those. So on your first question, on just where do we see constraints in our ability to execute against our CapEx plans, obviously, we are staying on top of supply availability. That is certainly one of the factors that will influence our CapEx spend in 2025, but we don't really have any updates to share on supply availability right now. we are planning to significantly ramp up deployment of GPUs in 2025, and we'll continue to engage with our vendors and invest in our own silicon to, meet those needs. And you asked how to think about capital intensity. We're not really, as both Mark and I alluded to in our prior comments, I think it is really too early to determine what long run capital intensity is going to look like. There are so many different factors: the pace of advancement in underlying models, how efficient can they be, what is the adoption and use case of our Gen AI products, what performance gains come from next generation hardware innovations, both our own and third party, and then ultimately what monetization or other efficiency gains our AI investments unlock. So again, I think we are sort of early in the journey here, and we don't have, I would say we don't have kind of anything to share about long run capital intensity yet. Your second question was about thinking about hiring needs. So it's a good segue. After infrastructure, employee compensation is the next largest driver of expense growth in 2025. And here, growth in employee comp and headcount more broadly is primarily driven by those areas that I mentioned, infrastructure, monetization, generative AI, reality labs, and regulation and compliance. And those generally are more technical organizations. That means that it is a higher cost base relative to business functions, where we are also expecting to keep headcount growth constrained. And, I would say we're focused on running the company efficiently, but at the same time, we feel like we're in a critical period in terms of making sure that we are investing to win, and we want to make sure that we staff those priority areas in a way that really positions us to best do that.
Krista, we have time for one last question.
And that question comes from the line of Ross Sandler with Barclays. Please go ahead.
Yeah, one for Mark on agents. So we all saw OpenAI's operator demo last week. So Mark, as the industry moves from chat to agentic behavior and more commercial intent moves into these AI products, I guess how are you thinking about monetization potential for Meta AI? And then how might Llama 4 reasoning help drive some of these new agentic experiences for Meta AI? Thank you.
Yeah, so I guess a couple of things that I'd say on this. One is, when you're thinking about agents and reasoning, a lot of this is about being able to perform multi-step tasks. So right now, the way that a lot of these systems work is you kind of say something and then it responds, and it's almost chat-like. But I think that the direction that it's going is you're going to be able to give it an intent or a task, and it's going to be able to go off and use sort of an arbitrary amount of compute, as much as you want to use on it, to be able to do a task. Some of the tasks might be pretty simple for people. Go buy a specific thing. Some of them might be really hard, like go write an app or optimize this code and like really make it as good as possible. And that type of thing, I think, is just going to start becoming more and more prevalent over the next year or two. So I think it's very exciting. It sort of will feel in some ways like the current products are just getting smarter, and others it'll feel like sort of a new form factor because it won't be as much like chat. But it's sort of another generation of these products. So I think it's just in general there's a lot to build and be excited about. I guess my note of caution, or just my kind of periodic reminder on our product development process, if you will, is we build these products. We try to scale them to reach
inventory levels
usually
normalize.
1 billion people or more. And it's at that point, once they're at scale, that we really start
Devices
focusing on
revenue
monetization.
will decline.
So sometimes we'll
Search and news advertising
experiment
ex-TAC revenue
with
growth should be in the
monetization
mid-teens.
before
From continued growth in both volume and
we're
revenue.
running some experiments with threads now, for example, but we typically don't really ramp these things up or see them as meaningfully contributing to the business until we reach quite a big scale. So the thing that I think is going to be meaningful this year is the kind of getting of the AI products to scale. Last year was sort of the introduction and starting to get it to be used. This year, my kind of expectation and hope is that we will be at a sufficient scale and have a sufficient kind of flywheel of people using it and improvement from that. That this will have a durable advantage, but that doesn't mean that it's going to be a major contributor to the business this year. This year, the improvements to the business are going to be taking the AI methods and applying them to advertising and recommendations and feeds and things like that.
And
So
operating
the
expense
actual
to
business
grow between 5
opportunity
and 6% in constant
for
currency,
Meta
or to
AI
be between
and AI
16.4
Studio
and
and business
16.5
agents
billion
and people
US
interacting
dollars.
with these AIs
Other income and expense
remains
is expected to be
outside of
roughly
25
negative
for the most
$1
part.
billion,
And I think that that's an important
primarily
thing for-
driven by
for us
investments
to
accounted for under the
communicate
equity
and
method.
for
As
people
a
to
reminder,
internalize as
we
you're
do
thinking
not
about our
recognize
prospects here.
mark-to-market
But
gains or
but
losses
nonetheless,
on equity method
we've run
investments. And lastly,
a process like
we
this
expect our
many
Q3
times.
effective
You know,
tax rate
we
to be
build a product,
approximately 18%.
make it good,
Now,
we scale it
some
to be large,
additional
we build
thoughts
out the
on the
business
rest
around
of
it.
the fiscal year and
That's what we
beyond.
do. I'm very
First,
optimistic,
FX.
but it's
With
going
the
to take some
strengthening of the U.S. dollar since October, we now expect
Thank you,
FX
everyone,
to
for
decrease
joining us.
Q4 revenue and COGS growth by more than 1 point and operating expense growth by roughly 1 point. Next, capital expenditures. We expect quarterly spend in Q3 and Q4 to remain at similar levels as our Q2 spend. In FY26, we expect to continue investing against strong demand signals, including customer contracted backlog we need to deliver against across the entirety of our Microsoft Cloud. However, the growth rate will be lower than FY25, and the mix of spend will begin to shift back to short-lived assets, which are more correlated to revenue growth. As a reminder, our long-lived infrastructure investments are fungible, enabling us to remain agile as we meet customer demand globally across our Microsoft Cloud, including AI workloads. As always, there can be quarterly spend variability from cloud infrastructure buildouts and the timing of delivery of finance leases. For the full fiscal year, we continue to expect double-digit revenue and operating income growth as we focus on delivering efficiencies across both COGS and operating expense. And given the operating leverage that we've delivered throughout the year, inclusive of efficiency gains as we scale our AI infrastructure and utilize our own AI solutions, we now expect FY25 operating margins to be up slightly year over year. And finally, our FY25 full-year effective tax rate should be between 18 and 19%. In closing, we are committed to delivering real-world AI solutions that help customers grow and improve their results. We are confident in our leadership position as we grow with our customers. Before turning to Q&A, I have one special thank you. Brett Iverson is moving to a new role here as the head of our Americas Sales Finance team. On behalf of the company, thank you for your tremendous impact leading investor relations for the past 4 years, and for the partnership with both Satya and me. And I'd like to welcome Jonathan Nielsen, the former head of finance for our security products, who is returning to investor relations to lead the team. With that, let's go to Q&A, Brett.
Thanks, Amy. We'll now move over to Q&A. Out of respect for others on the call, we request that participants please only ask one question. Operator, can you please repeat your instructions?
Thank you. Ladies and gentlemen, if you would like to ask a question, please press star 1 on your telephone keypad, and a confirmation tone will indicate your line is in the question queue. You may press star 2 if you would like to remove your question from the queue. For participants using speaker equipment, it may be necessary to pick up your handset before pressing the star keys. And our first question comes from the line of Keith Weiss with Morgan Stanley. Please proceed.
Excellent. Thank you guys for taking the question. And echoing Amy's comments, Brett, congratulations on the new role. It's been a pleasure working with you, and best of luck in that new role. Looking at the quarter, another really solid quarter when it comes to commercial bookings. But again, we were a little bit disappointed on Azure coming in at the bottom end of the guidance range. Amy, I was hoping you could dig into perhaps what some of those execution issues were, what the resolution to those issues were. And do we still feel comfortable in the acceleration into the back half of the year that you were talking about after the June quarter and after last quarter? Thank you very much.
Thanks, Keith. Let me spend a little time on that, about what we saw in Q2, and give you some additional background on the near-term execution issues that we're talking about. First, let me be very specific. They are in the non-AI ACR component. Our Azure AI results were better than we thought due to very good work by the operating teams, pulling in some delivery dates, even by weeks. When you're capacity constrained, weeks matter, and it was good execution by the team, and you see that in the revenue results. On the non-AI side, really the challenges were in what we call the scale motions. So think about primarily these are customers we reach through partners and through more indirect methods of selling. And really the art form there is as these customers, which we reach in this way, are trying to balance how do you do an AI workload with continuing some of the work they've done on migrations and other fundamentals. We then took our sales motions in the summer and really changed to try to balance those two. As you do that, you learn with your customers and with your partners on sort of getting that balance right between where to put our investments, where to put the marketing dollars, and importantly, where to put people in terms of coverage and being able to help customers make those transitions. And I think we are going to make some adjustments to make sure we are in balance, because when you make those changes in the summer, by the time it works its way through the system, you can see the impacts and whether you have that balance right. And so the teams are working through that. They're already making adjustments. And I expect while, we will see some impact through H2, just because when you work through the scale motion, it can take some time for that to adjust. I feel good that the teams understand and are working through that. So hopefully that's just helpful on that. Then, we've talked a little bit about Q3. And so we've talked about 31 to 32 after publishing a 31 this quarter. Our AI results that we had felt good about and talked about our ability to land that revenue is the same. So again, in Q3, we are working from a pretty constrained capacity place, and that's no different than it was our expectation to be in that position last October when I talked to you all. And when I talk about being in a capacity constraint, it takes two things. You have to have space, which I generally call long-lived assets, right? That's the infrastructure and the land, and then you have to have kits. We're continuing, and you've seen that's why our spend has pivoted this way, to be in the long-lived investment. We have been short power and space. And so as you see those investments land that we've made over the past 3 years, we get closer to that balance by the end of this year. And so the confidence on the AI side continues to be there. In terms of being able to sell, utilize, and be, I think, encouraged by the signals. What we're seeing is waiting to see just how the non-AI ACR works through the scale motions in H2. But in general, the only thing that's changed is really that scale motion from my seat, Keith. Hope that's helpful. Sanjay?
Yeah, I think, Amy, just one thing I'd add, Keith, to your question is, as Amy said, the AI growth rate is actually better than what we expected, and we worked through some of the supply stuff, and more importantly, some of the workloads are scaling well. And when you look underneath any of these AI workloads, the other thing that is good is the ratio of even what we would call just regular storage, data services, app services. So underneath a ChatGPT or a Copilot or even the emerging AI workloads in the enterprise. So that's all good. The enterprise workloads, whether it's SAP or whether it's VMware migrations, what have you, that's also in good shape. And it's just the scale place where when Amy talked about this nuance, right? How do you really tweak the incentives, go to market? At a time of platform shifts, you kind of want to make sure you lean into even the new design wins, and you just don't keep doing the stuff that you did in the previous generation. And that's the art form Amy was referencing to make sure you get the right balance. But let me put it this way. You would rather win the new than just protect the past. And that's sort of another thing that we definitely will lean into always.
Thanks, Keith. Operator, next question, please.
The next question comes from the line of Mark Moerdler with Bernstein Research. Please proceed.
Thank you very much for taking my question. Can you give more color on what drove the far larger than expected Microsoft AI revenue? We talked a bit about the Azure AI component of it, but can you give more color on that? And our estimates are that the Copilot was much bigger than we expected and growing much faster. Any more details on the breakdown of what that Microsoft AI beat would be great. Thanks.
Thanks, Mark, for the question. Yes, that was, as we talked about, better than expected. A couple of pieces to that, which you correctly identified. Number one is the Azure component we just talked about. And the second piece, you're right, Microsoft Copilot was better. And what was important about that, we saw strength both in seats, both new seats and expansion seats, as Satya talked about, and usage, which doesn't directly impact revenue, but of course indirectly does as people get more and more value out of it. And also, price per seat was actually quite good, which does have a good signal for value. So those are the biggest pieces, Mark, of that sort of outperformance in terms of our expectations.
Thank you.
Mark. Operator, next question, please.
The next question comes from the line of Brent Thill with Jefferies. Please proceed.
Thanks. Satya, you mentioned DeepSeek a couple times in your prepared remarks. I think everyone would love your thoughts on what you're seeing there. And are we seeing AI scale now at lower costs? Are we reaching a mark where you can see that, or do we still have some time to go? Thanks for your thoughts on this.
Yeah, thanks, Brent. In my remarks, I talked about how, in some sense, what's happening with AI is no different than what was happening with the regular compute cycle. Right? It's always about bending the curve and then putting more points up the curve. So there's Moore's law that's working in hyperdrive. Then on top of that, there is the AI scaling laws, both the pre-training and the inference time compute that compound, and that's all software. You should think of what I said in my remarks, which we've observed for a while, which is 10x on improvements per cycle just because of all the software optimizations on inference, and so that's what you see. And then to that, I think DeepSeek has had some real innovations, and that is some of the things that even OpenAI found in 01, and so we are going to obviously now that all gets commoditized and it's going to get broadly used, and the big beneficiaries of any software cycle like that is the customers, right? Because at the end of the day, if you think about it, right, what was the big lesson learned from client server to cloud? More people bought servers, except it was called cloud. And so when token prices fall, inference computing prices fall, that means people can consume more, and there'll be more apps written. And it's interesting to see that when I reference these models that are pretty powerful, it's unimaginable to think that here we are in sort of beginning of 25, where on the PC you can run a model that required pretty massive cloud infrastructure. So that type of optimizations means AI will be much more ubiquitous, and so therefore for a hyperscaler like us, a PC platform provider like us, this is all good news as far as I'm concerned.
Thank you.
Thanks, Brent. Operator, next question, please.
The next question comes from the line of Karl Keirstead with UBS. Please proceed.
Thank you. Maybe this one as well for Satya, and it's also away from the numbers. But Satya, I wanted to ask you about the Stargate news and the announced changes in the OpenAI relationship last week. It seems that most of your investors have interpreted this as Microsoft for sure remaining very committed to OpenAI's success, but electing to take more of a back seat in terms of funding OpenAI's future training CapEx needs. I was hoping you might frame your strategic decision here around Stargate, and Amy, whether there's any takeaway for investors from that decision in terms of how you're thinking about CapEx needs over the next several years. Thank you.
Yeah, no, thanks for the question. So we remain very happy with the partnership with OpenAI, and as you saw, they've committed in a big way to Azure, and even in the bookings, what we recognize is just the first tranche of it. And so you'll see, given the role we have, more benefits of that even into the future. And obviously their success is our success because of even all the other commercial arrangements that we detailed out in the blog that we put out even commensurate with that announcement. But to your overall point, the thing that I would say is we are building a pretty fungible fleet, right? We're making sure that there's the right balance between training and inference. It's geo-distributed. We are working super hard on all the software optimizations, right? I mean, just not the software optimizations that come because of what DeepSeek has done, but all the work we have done to, for example, reduce the prices of GPT models, over the years in partnership with OpenAI. In fact, we did a lot of the work on the inference optimizations on it, and that's been key to driving, right? One of the key things to note in AI is you just don't launch the frontier model. But if it's too expensive to serve, it's no good, right? It won't generate any demand. So you've got to have that optimization so that inferencing costs are coming down and they can be consumed broadly. And so that's the fleet physics we are managing. And also remember, you don't want to buy too much of anything at one time because the Moore's law every year is going to give you 2x, your optimization is going to give you 10x. You want to continuously upgrade the fleet, modernize the fleet, age the fleet, and at the end of the day, have the right ratio of monetization and demand-driven, monetization to what you think of as the training expense. So I feel very good about the investment we are making, and it's fungible, and it just allows us to scale more long-term business.
And maybe, Carl, just to reiterate a little of the comments that I made on CapEx, because I think it's helpful to ground a bit more in what Satya is saying a fungible fleet means. We have, and I think we talked about it, close to $300 billion of RPO. That is committed customer contracts that need to be delivered on, and the faster we can do that and the more efficiently we can do that, the better off we are, not just the OpenAI partnership, which is a piece of that, but with the entire platform that we need to deliver for our customers. And I think the other thing that's sometimes missing is when we say fungible, we mean not just the primary use, which we've always talked about, which is inference, but there is some training, post-training, which is a key component. And then there's just running the commercial cloud, which at every layer under every modern AI app that's going to be built will be required. It'll be required to be distributed, and it'll be required to be global. And all of those things are really important because it then means you're the most efficient. And so the investment you see us making CapEx, you're right, the front end has been this sort of infrastructure build that lets us really catch up, not just on the AI infrastructure we needed. Think about that as the building itself, data centers, but also some of the catch up we needed to do on the commercial cloud side. And then you'll see the pivot to more CPU and GPU. And that pivot will more directly correlate to revenue. And it'll be contracted either with the partnership that you asked about with OpenAI or with others. And so I do think the way I want everyone to internalize it is that the CapEx growth is going through that cycle pivot, which is far more correlated to customer contract delivery, no matter who the end customer is.
Thank you.
Thanks, Carl. Operator, next question, please.
And the next question comes from the line of Brad Zelnick with Deutsche Bank. Please proceed.
Thank you very much for taking my question, and I'll echo my congrats and gratitude to Brett as well. Satya, as we think about Microsoft's very rich Copilot portfolio, now having been in market for over a year with the products and precision only getting better and the cost of inference coming down, how do you think about the journey from here and perhaps the ability to package and evolve the go-to-market to address the broadest range of customers and customer requirements out there? Thanks.
No, thanks, Brad, for the question. In fact, you saw us make two announcements recently. One is on the M365 Copilot side, we now have the Copilot Chat. So this is now going to be broadly deployed across the entire install base effectively because you can go have this now turned on by IT, and everybody can start using web-grounded chat with all the enterprise controls right away, and it has Copilot Studio built in, and so that means they can start building agents. So we think of that plus the full Copilot as a good combination that I think will accelerate, quite frankly, in terms of just seat usage and agent building and what have you. So that's sort of one. And the other thing is you also see even on the consumer side, we just yesterday launched O1, or the Think Harder feature on Copilot now that's powered by O1. It's available globally, right? So you can see the benefits of inference optimization and the cost coming down means you can drive more ubiquity of what were features that once were sort of premium tier, and that's all definitely something that we will do across. Right? The same thing is happening in GitHub Copilot, same thing in Security Copilot. So across the length and breadth of our portfolio, you'll see that.
Thank you.
Thanks, Brad. Operator, next question, please.
The next question comes from the line of Brad Reback with Stifel. Please proceed.
That's great. Thank you very much. Satya, if you look out several years, any sense of what % of inference done on Azure will be done on proprietary models versus open models? And with that said, does it matter to Microsoft at the end of the day? Thanks.
Yeah, it's a good question because at some level, what you're seeing is effectively lots of models that get used in any application, right? When you look underneath even a Copilot or a GitHub Copilot or what have you, you already see lots of many different models. That you build models, you fine-tune models, you distill models. Some of them are, models that you distill into an open source model. So that, so there's going to be a combination. So we've always maintained that it's always good to have frontier models. You want to always build your application with high ambition using the best model that is available, and then optimize from there on. So that's also another side. Like there's a temporality to it, right? What you start with as a given COGS profile doesn't need to be the end because you continuously optimize for latency and COGS and putting in different models. And in fact, all that complexity, by the way, has to be managed by a new app server. So one of the things that we are investing heavily on is Foundry, because from an app developer perspective, you kind of want to keep pace with this flurry of models that are coming in, and you want to have an evergreen way for your application to benefit from all that innovation. But not have all the dev cost or the DevOps cost or what people talk about AI ops cost. So we are also investing significantly in all the app server for any workload to be able to benefit from all these different models, open source, closed source, different weight classes, and at the same time, from an operations perspective, it's faster, easier for you.
Great, thank you.
Thanks, Brad. Operator, next question, please.
And the next question comes from the line of Brad Sills with Bank of America. Please proceed.
Oh, wonderful. Thank you so much. Great to hear about the strength you're seeing in Copilot. Would love to get some color as to where you're seeing that strength. Is it departmental deals, customers moving from proof of concept to departmental deals, maybe multiple departmental deals in the enterprise? And you mentioned some uptick in usage trends. Would love to get some color on just the common use cases that you're seeing that give you that confidence that will ramp into monetization later. Thank you.
Yeah, I mean, I think the initial sort of set of seats were for places where there's more belief in immediate productivity, a sales team, in finance or in supply chain, where there is a lot of, like, for example, SharePoint grounded data that you want to be able to use in conjunction with web data and have it produce results that are beneficial. But then what's happening, very much like what we've seen in these previous generation productivity things, is that people collaborate across functions, across roles, right? For example, even in my own daily habit, it's I go to chat, I use work tab, I get results, and then I immediately share using Pages with colleagues. I sort of call it think with AI and work with people. And that pattern then requires you to make it more of a standard issue across the enterprise. And so that's what we're seeing. It starts maybe at a departmental level. Quickly, the collaboration network effects will effectively demand that you spread it across. You can do it by cohort and what have you. And so what we've made it easier even is to start with Copilot Chat plus this. And so that gives the enterprise customers even more flexibility to have something that's more ubiquitous.
Wonderful. Thank you so much.
Thanks, Brett. Operator, we have time for one last question.
And the last question will come from the line of Brent Bracelin with Piper Sandler. Please proceed.
Thank you for taking the question here. Good afternoon. I wanted to go back to commercial bookings. Commercial RPO, I think, increased $39 billion sequentially. That's the most we've ever seen on a sequential basis. Commercial bookings growth, 75% constant currency. That's 2x higher than we've seen in the last decade. I appreciate there's some volatility with this metric, but it does feel like this quarter there was a bit of a sea change relative to momentum on backlog and bookings. Can you just talk about maybe the breadth of where that strength came from? Was it broad-based? Was there a couple large deals? Any color there would be helpful. Thanks.
Thanks, Brent. It's a great question. We talked a little bit about one of the main drivers, which was one of the Azure commitments that OpenAI has made. And I do want to say, while that is obviously a big component, you'll continue to see OpenAI make commitments. So I want to separate the concept that it's one time versus an ongoing relationship that'll grow as they grow, which it absolutely will. And to your question on what else is participating in that number, first, we did have very good core motions. Our core motions are things like, to your point, renewals of our existing contracts, add-ons to those contracts, upsells, like, for example, Copilot or GitHub Copilot or other processes. And I think that's important. We also had a good E5 quarter, which when we talk a lot about M365 Copilot, I sometimes forget to also talk about suite momentum. And we saw that as well this quarter, which we felt very good about. And then the final component is large Azure commitments. And those really did look as we expected, which is good. To your point, in that you're seeing a really broad-based growth, those Azure commitments take two forms. One, it's existing customers who've worked through their commitments and are making larger commitments, which is a good commitment sign for the platform. And then you have new customers making commitments, and we also saw that this quarter. And so to your point, sometimes I think a big number that looks like this can make you think it's just one thing. I think you're right. Some of it was one thing, but a lot of it was good execution consistently across the workloads.
Helpful color. Thank you.
Thanks, Brent. That wraps up the Q&A portion of today's earnings call. Thank you for joining us today, and we look forward to speaking with all of you soon.
Thank you all.
This concludes today's conference. You may disconnect your lines at this time and enjoy the rest of your day.
All right. Yeah, I mean, the stock prices say it all. Microsoft had been so hot, it's kind of due for a breather. Um, I'm surprised the market likes Zuck's CapEx spend. I don't know if they're just giving him room or what. That's a pretty huge GPU spend. And he's saying that that includes speed improvements and that includes longer useful life. So that's pretty wild. I didn't listen to Tesla, so I'm not really sure what's happening there. I'm back in some crypto shorts. I got temporarily dislocated due to an unforeseen circumstance. Optimus, 10 trillion. Wow. Pretty out there. Well, it must have been a mistake with the software, but let's just say I'm back. I'm sure Trump with Fartcoin, Popcat, and Vine. I'm not long. Long? Yeah, Quantum is my biggest short. Hello, kitty cat. RFK will never take my Pringles. Why don't I trade after hours? Who says I don't trade after hours? I don't really like to trade in general. I just put my position on and wait. Yeah, you can make good money at Big Four accounting. Just might take a while, but sure. No, I've never used one of those kinds of keyboards, although I should. No Goodell keyboard yet, although we've talked about it. Xiaomi? The phone company? The whole point of the affiliate program is you go to other places to market. I think you go to the account section. How does it work? I don't know. I think you should be able to enroll as a student, but I could be wrong. I've held a short for a while. Ooh, Vine is getting destroyed. I love it. Well, when you have more cash than market cap, typically what happens is management's going to burn the cash. Been in many of those types of situations. Sometimes they can work, sometimes they don't. You got to usually boot management out of the way to get your money back, which isn't fun. A lot of work has to be done to get that. Lays is down, but we have many more quantum stocks to go. They're all going to go down 90%. The question is, can you hang on until then? All right, what should I eat that's like really easy, tastes good, is not too filling, but is not too... Like, I'm looking for something almost bland, like something that won't make me sick. Shawarma. You don't know me very well. Pizza's not a bad idea. Don't spam, though. That's a pretty stupid thing to spam anyway. Yeah, maybe a sandwich. I was thinking Jersey Mike's. Oh, hell no. You guys don't know me. I don't eat anything exotic. Well, pizza doesn't sound too bad either. Pizza's a little greasy, though. It's not necessarily great for your stomach. What does that mean? Eat like a peasant. Should I order some steak and lobster and caviar? What do you eat like? These fucking people, man. I know, exactly, Ches. Jersey Mike sounds good. Man, Vine's getting smoked. Smoked. Think about cryptos. It trades so wide. So like Vine was 40 cents 2 days ago. It hit 22 cents like a day ago. And now it's 29.9 cents. Vine is some random crypto started, I guess, by the old Vine guy. I don't know if they're hoping that like they can bring back Vine, but that has nothing to do with the crypto. Like it wouldn't help the crypto. I mean, it would help it attention-wise, but it's literally not going to do anything else. Yeah, X is never going to help out anybody. The guy has a huge amount of debt, right, that the company owes or owes lenders. So it's just kind of bizarre. You know, they're certainly, if they were going to do something crypto related, they're sure as hell not doing it with some rando. So it's just a LARP. Pretend LARP. Dream. Fever dream. Yeah, I know a lot of people that work at X. There's just no fucking... Don't even dream of it. I think they'll do some at some point. That's really helpful, Sanu. Thank you. Fuh. Sam Hyde's pretty funny. Yeah, they've been thinking about bringing back Vine for a long time. My friend was the main guy at Vine who integrated it into Twitter. There's just no way. Why would they dilute their brand? Doesn't make any sense. Yeah, I would do something with Adam Friedland. Oh, man. What you want, kitty? I love you. Yeah, I enjoy being a contrarian. But you try not to enjoy it too much, because then you just become a contrarian for the sake of being contrarian, which isn't good. No, I haven't traded Intel. I would be bullish if I were to. I would lean bullish, I guess, but I'm not there. NVIDIA is just such a better company, but that's priced in. Or I think it's priced in. We don't know how much it's priced in. One of the things about Elon said it's going to be Optimus is going to be a $10 trillion business. Well, who do you think is going to power that? It's going to be powered by NVIDIA. I mean, robotics is what's going to save NVIDIA. I don't know if it's this cycle or next cycle or whatever, but robotics, I mean, how lucky can this company get? If robotics becomes the next big thing, which it very well could, and I think might, you could see, every robot's going to have an NVIDIA chip in it, which is pretty bullish. Elon's talking about there'll be more robots than people. I'm looking at Novartis right now. Well, self-driving cars is another big win for NVIDIA at some point. You know, I don't know. I mean, I think the Waymo uses some kind of NVIDIA chip. So if that scales, that'll be pretty exciting. I don't think anyone's running their own local LLMs, Mustafa. Maybe guys like you and me, but nah. Maybe, listen, man. At best, a couple hobbyists, but it's not about bullish on NVIDIA long term. It's more about just price sensitive, you know? You really think people are going to do Python environments and install packages to run their own local LLM or use a Meta product for free? It's a pretty simple choice there. It's like saying everyone's going to use Linux. I don't even think Fortune 500 is going to do it. And they're more important, I would agree. Yeah, people don't want to implement this shit. I'm not looking at anything too complicated in here. I'm just waiting for my food, really. Vine is useless. Nobody's going to remember Vine in a week. Every 3 to 6 months, people go on Twitter and say, "Oh, bring back Vine, derp." Never happens. Never will happen. I got an Italian sub from Jersey Mike's. Kind of real basic meal. Yeah, I mean, to the extent X wants to compete with TikTok, it doesn't make sense to dilute your brand, and then X may acquire TikTok. I have to look at the new farming stuff. At first blush, I didn't like the mitochondrial stuff that much. Yeah, I agree. X is been a little unproductive, it looks like. But it also looks like they're going to do something in payments. Going to become a bank. Elon's getting into payments again. Pretty wild. What does this guy not do? He does it all. Luigi's still loose? No. Luigi's not on the loose. Oh, I woke up my kitty. Poor cat. Vine is super weak. Vine's like all down ticks. Yeah, me too, Vinny. Sam Lesson? I don't even know who that is. Rings a bell, though. Some tech dude, right? There are a lot of group workouts, yeah. No, I do not travel to New Jersey often. I had to pay more attention to Regeneron. I mean, obviously they're going to have a challenge with biosimilars. That's pretty significant, and Dupixent's still worth a lot, but growing through Eylea expiry is going to be tricky. Yeah, I looked at the Alarity press release. It looks kind of scammy. That company was pretty unreliable. It's a good idea, Ladger. I mean, right now I think you know what it is. That's my kitty cat. I love you. What a nice kitty cats. Oh, yes. I love you too, Nibbles. Yes, I do. When the sandwich comes, I bet you guys want some. I bet you do. You guys want treats, huh? You want some treats, huh? Dale Chappelle got charged. Yeah, Dale Chappelle got indicted. We have a lot of APIs. That's our business, buying APIs. This is Wall Street Journal. All the meme coins are super correlated. They basically have the same chart. I gotta say, Vine looks pretty bad. So maybe I'll press that one a little bit harder. Yeah, I mean, you can hedge in crypto, sure. You can buy Bitcoin, for example, or some other crypto. People are making fun of me for not shorting enough, I guess. Because everyone in crypto has multi-million-dollar portfolios. Everybody in crypto is trading, $1 million orders. Nobody in crypto would ever LARP. Nah. Yeah, you could short a breakdown That happens. A lot of traders like to do that. I like to do that. If a stock's breaking down, you can press it. I am still short Rigetti. It's been very painful. There are generally not options, correct? Should you what? I mean, shorting strength versus shorting weakness, there's no alpha in either one. I earned my first million at the same time I earned my first 10 million. So it all came at one shot. When do you think GME will MOAS? Doesn't that imply that what I think that implies you're making an implication on my behalf. I don't remember. I was like 28 maybe. No. Alpha male does not help you make alpha in the market. If anything, read about the Steve Cohen guy who took estrogen. Beta neutral hedge funds sound good in principle, but you ever actually look at their returns, they're often pretty shitty. Some of the multi-strats are pretty good because they leverage up, you know, the beta neutral returns. Again, there's no alpha specifically in selling options, maybe a very slight edge in selling premium, but it depends, you know, sometimes premium's cheap. Sometimes it's expensive. Should I take over Hindenburg? I don't know what that would even mean. What do I get? Just the name? I don't know. I think he, you know, it's easier for everyone to have their own brand, if that makes sense. On the spectrum, no. I mean, I being a dedicated short selling analyst is difficult, to say the least. Yeah, you gotta get some estrogen to do Rust. Memory safe programming. Ah, food is here. Don't go anywhere. I'll be right back. Thankfully, it's cold food. Pretty basic. What are you writing? 000B? What the fuck's wrong with you? Short Vine at 31 cents. It's working really well. It's not an uptick in sight. Hey, Curtis, what's up, man? Some of you guys have to learn how to do your own research. One of the things that I've been working on, Curtis, that I need to work harder on is looking at circuit depth. Circuit depth and number of gates.
I probably did say that.
Did you say that Lyme disease is highly likely a materially engineered bioweapon? I made sure I put in the highly likely. Did you say Lyme disease is a highly likely
This guy's
militarily
douchebag.
engineered bioweapon?
I probably did say that.
Did you say that?
And that's what the developer of
I
Lyme
want
disease
all of our colleagues to hear it, Mr. Kennedy. I want them to hear it. You said yes. Did you say that Lyme disease is
Fucking Reid Hoffman writing a book. This is why he's writing the book. Microsoft's calmed down a bit. It's nibbles and trashy. Yeah. I mean, the thing about guys like Sam Lessin is presumably they have the money to not rug. Oh my God. Farcoin has not surged. Farcoin has dropped. It's been dropping like a rock, like all of crypto right now. Come on, Senu. I thought we were friends. Well, that's nice of you, Korea. Thank you. I'm pretty bearish. Shut up, kitty. I remember Geo Bowden. Oh, man. Is this right? No way that's right. $1 million market cap? Wow. Maybe I will CTO it.
What, Larry? What, Larry? What do you want?
That is Lulu Cheng, my friend. White Dudes for Harris t-shirt. Oh my God. Shush. Silly kitty. I love you. Quiet, kitty. Yeah, well, I do have my profile as like the crypto. Harris is like, we have to make crypto safe for people of color, which was fucking just amazing. Shut the fuck up, kitty. No, I don't know Nick Mullen. She said it, not me. All right, I'll give you some treats in a minute. Stupid. Shut the fuck up. All right, let's go. I'll be back. I'm just gonna give her some treats real quick. Okay. Okay, let's go. All right, 5 treats apiece. Oh, nice. So you can now chat in Godel. Godel has a chat room for every stock. Pretty sweet. Yeah, we'll add Fartcoin chat. I mean, crypto chats. It's just going to be people typing hot air rises. Yeah, it's really funny that Joe Biden is worth absolutely nothing. Shush. Shush.
of vaccines. Are you supportive of this clothing, which is militantly anti-vaccine? Are you supportive of this? I've had nothing to do with. Are you supportive of these onesies? I'm supportive of vaccines. Are you supportive of this clothing, which is militantly anti-vaccine?
Oh boy.
But you're not awake now. Yeah. Hey, when you gotta wake up, sweetie pie, and let's talk and maybe we'll dance again.
Order cancelled.
But you're not awake now. Yeah, that's bothering me. I gotta touch you and you're sleeping. What's this? Is this a for real sleep? I hear you. Yeah, I hear you breathing. Okay. Do you? Yeah.
Sad, but beautiful too. What's AMP? Oh, man. All right, guys, if you want to keep hanging out, I'll be on Discord. So go jump on Discord. Let me give you an invite. Should work, discord.gg/Martin Shkreli, but just in case you need another invite. Here you go. All right, guys, have a good night. See you tomorrow.